Next week, another full day bank branch audit series. Chairman will share more about it. Now we'll start the session with ICI motto. Request Shehzad Bhai to share the ICI motto. Shehzad Bhai, I think you need to mute all participants. Yes. Shehzad Bhai, are you there?
Actually, my PC got in updates mode. It's restarted. Not able to play motto.
Okay. Chairman, you can. Is it possible for ICI motto? Okay. Answer.
So you have to unmute.
Yeah. Unmute, Chairman sir. Yes.
Yeshasupteshu jagrati Yeshasupteshu jagrati Kamam 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 kamusho Pusho nirvimanaha nirvimanaha Tadeva shukram tadabrahma tadabrahma Tadeva mritamucchate Tasmin lokaha shitaha Sarve tanuna charitaschana yamitascha Etadvaita 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 etadvaita
Thank you. Request Chairman C. Harit Dhariwal to give keynote address.
उम्मीद के अंबर में हम
Thank you, Anjali Ben. So, faculty for the session, CA Dhananjay Gokhale sir, Secretary of Ahmedabad branch, CA Anjali Choksi, coordinator for today's session, CA Ankit Thakkar, all the seniors in the profession who have joined the session, and my dear friends, a very good morning to everyone. I think after a marathon session yesterday, I was just discussing with sir, we had almost 4 hours of discussion on the amended LFAR. Today, we are back with another session on the bank branch audit, on the IRAC special focus on COVID-related special dispensation and status quo ordered by Supreme Court. So I think it is one of the very important topics as far as bank audits are concerned. And today I'm very happy. We are very happy to have CA Dhananjay Gokhale sir joining us virtually from Mumbai. I would just like to mention here a special thing that these presentations will be shared to all the registered participants, as most of them were inquiring yesterday. We will be sharing it to you on the registered email ID. And second, next week also we'll be having few sessions on bank audit. As I said yesterday also, this time our specific focus is to concentrate on each area of bank audit in a much more elaborate manner. Yesterday we had only discussion on the LFAR for 4 hours. So we will be having sector specific and point specific sections on each part of the bank branch audit, and then we'll be having a full day conference on the bank branch audit. With this, I think I welcome sir again. Thank you so much, sir, for agreeing to come virtually on a Saturday morning. And I would now request CA Ankit Thakkar to introduce Dhananjay sir. Yeah, Ankit. I think Shazad, you need to unmute him.
Okay, sir.
Yeah, Ankit bhai.
Yes. Thank you, Harit bhai. Thank you, Anjali madam. Good morning, everyone. We have CA Dhananjay Gokhale sir with us to guide us and make us learn about new updates. We are sure that we will learn from his experience and professional approach. He is a Bachelor of Commerce from University of Mumbai and fellow member of ICI, and he is in practice since last 24 years. He is a founder partner of Dhananjay J. Gokhale and Company, chartered accountant specialized in providing management consultancy and auditing and assurance service in corporate and banking sector. He was a co-opted member of Auditing and Assurance Standard Board of ICI for the financial year 2018 and 19 and was nominated as subgroup member of Banking, Insurance and Pension Committee of WIRC of ICI for the financial year 2018 and 19. He was convener of the study group formed for ICI Guidance Note on Audit of Bank 2019 edition. He is a member of expert panel constituted by Auditing and Assurance Standard Board of ICI for addressing in the bank audit queries of the member since financial year 2011 and 12 till date. He has authorized article in ICI magazine, ICI Guidance Note on Audit of Banks of 2016 to 2021 editions, manual on concurrent audit of banks, reference material published by WIRC on statutory bank audit, and background material for Executive Master Program for New Age Auditors by Center of Audit Quality of ICI. He has handled variety of assignments related to arena of bank audit, including statutory central audit of PSBs and merger and acquisition of urban cooperative banks and consultant to Board of Bank. He is regular speaker at various seminars on standard auditing and bank audit across various regions and branches of ICI. He had been a speaker at staff training seminar organized by public sector, private sector, and urban cooperative banks and association of banks. He had been a visiting faculty at University of Mumbai also. Now I request to the sir, please provide your views on IRAC special focus on COVID related special dispensation and status quo ordered by Honorable Supreme Court.
Thank you, Ankit ji, for introduction, and thanks to Ahmedabad branch for inviting me for this session. Even though it is virtual, I had been there at Ahmedabad multiple times. So, Ahmedabad branch is very close to me, similar to what I am there with WRC. And as far as today's topic is concerned, IRAC norms. We'll be having a kind of a refresher kind of a thing as far as the IRAC norms are concerned, because the basic IRAC norms have remained same. There is no change in IRAC norms as such. What has changed is that there are a couple of COVID-19 related circulars which have been issued, and there is a Supreme Court order which is an interim order. It's not really a status quo per se order. It's having a little different kind of nature in that particular order. So we will have more focus on COVID-19 circulars and the Supreme Court interim order. I will express my views about a certain little controversial points related to COVID-19 circulars, and in fact, I will appeal the members to apply their own, professional mind and decision-making ability to interpret those circulars, because there is a little bit of not ambiguity, but there are different kind of opinions which one can derive from this COVID-19 circular as well as Supreme Court order. And throughout the session, since it's a virtual session, I cannot really practically see all of you, but you can post your queries in the chat box so that I can parallelly address those queries also. To the extent possible, we'll try to address those queries there and there itself. Means whenever we are on a particular slide, we'll try to address those queries, so that it becomes more interactive, because otherwise virtual session is a kind of challenge for speaker as well as audience, and I will not like to have this as a monologue. And in the past, whenever I have been there in Ahmedabad, it was always an interactive session, so I presume that can continue even in virtual mode. Before we start with the presentation of the slide, couple of things which I just wanted to mention before we go to the topic. First thing is that there is a eco survey, that is economic survey, which was published for 2021. And for the first time, it was having a mention of bank audit related certain discrepancies, especially about some bitter comments were there about the auditors as well as the bankers, especially from evergreening point of view. So I will suggest all of you to just go through that eco survey, which is available, online to all, everyone. Why I'm saying bitter comments is that there are some comments which have been posed on bankers also by saying that the bankers are slipping over the assets, and the same way some comments are there on the auditors also for not able to identify accounts which have been evergreen and which have been shown as standard asset. Without really getting into why such comments are coming, I will just like to point out one thing, that firstly, as far as evergreening concept is concerned, that evergreening concept doesn't have any mention in any RBI circular. So having said that, at the same time, we cannot say that we don't have any responsibility to unearth evergreening cases. So just keep this thing in mind, that how the world at large, or how the stakeholders are viewing auditors as well as bankers from a different perspective, especially from evergreening point of view. If you happen to come across any case wherein you suspect that there is evergreening has happened, don't shy away from mentioning that particular word in your report also, presuming that you have already taken the due care to ensure that it's a case of evergreening. Secondly, as far as restructuring concept is concerned, restructuring concept have remained same. Only thing is that as far as COVID-19 affected borrower accounts are concerned, there is some kind of relaxation which is given by RBI under various COVID-19 circulars. And as far as this dispensation is concerned, it's basically to retain the class of asset. So restructuring concept remains same. What is mean by restructuring? There is no change in that process or concept. Only thing is that there is a dispensation given by RBI as far as downgrading of asset is concerned. So you can retain the class of asset provided whatever conditions are mentioned in COVID-19 circulars are satisfied by that particular borrower. So today I intend to cover maximum part of this. This presentation is a little bigger one because even though the earlier like S4A and other concepts have been dispensed of, I have just tried to retain that in the presentation so that whenever you receive this presentation in soft copy format, you can make use of that in case if you come across any account which might have been restructured, say 1 year back, 2 years back, or 3 years back under any of the earlier schemes. So I have mentioned that those schemes are dispensed as of now. So in the current year audit, those are not really relevant. But if you are checking any earlier years advances, that will be handy for you. Now, as far as RBI circulars are concerned, the basic RBI circular which you need to be looking at is the master circular dated 1st July 2015, that is the IRAC master circular. Then we have master directions on relief measures in areas affected by natural calamity circular, that is dated 17th October 2018. Then we have prudential framework for resolution of stress asset, which was issued on 7th June 2019. So it's not really a new circular, but that circular still exists and continues. Then we have MSME relief related circular. The first circular was issued on 7th February 2018. Then there was a clarificatory circular on 8th June 2018. Then the subsequent circulars are kind of giving an extension to the same scheme. So we have 3 circulars in all, that is 1st January, 11th February 2020, and then we have latest one which is 6th August 2020. As far as current year audit is concerned, the last 2 circulars, that is 11th February 2020 and 6th August 2020 circular will be relevant as far as financial year 2020-21 is concerned. And these are the COVID-19 related circulars which have got issued. So it started from 27 March 2020, that is almost a year back, when the COVID-19 regulatory package was issued. Then there was a circular in continuation of that earlier circular, that is dated 17th April 2020 circular, which gave a relief in terms of asset classification and provisioning. Then there was another circular on the same date, which was related to prudential framework for resolution of stress asset, which was giving an extension period, for that resolution package. Subsequently, there was a circular which was issued on 23rd May 2020. This circular was basically to give another extension of 3 months for this earlier extension, which was given by way of 27 March circular. Then we have 6th August 2020 circular, which is a resolution framework for COVID-19 related stress assets. This is a circular wherein restructuring is allowed for certain class of assets. It's not really for each and every account, but it's only restricted to certain class of assets. We will see this particular circular in detail in subsequent slides. And we have 13th October 2020 FAQs, which have been published by Reserve Bank of India to give a more clarity about 6 August 2020 circular. So these are the total almost 8 circulars which have got issued, besides 9th circular of MSME dated 6 August 2020. Now let's first have a basic thing discuss about IRAC norms, about what is the basic classification norms are there. Now, as far as classification of asset is concerned, what RBI expect is that the bank has to do the classification of asset on the basis of an objective criteria, and the criteria which is followed by the bank has to be followed in a consistent and uniform manner. What it means is that whenever you are applying a particular criteria to a particular account, the same logic should prevail, or same logic should get extended to all types of advances. So there is no distinction which is made between two accounts based on security values, or based on background of that particular borrower, or based on credit rating of that borrower. So the criteria is objective, and practically there is no subjectivity as far as IRAC norms are concerned. Even though at times auditors as well as bankers might be under a false impression that there is a subjectivity under IRAC norms, or there is a kind of authority which is given to the auditor to decide about whether an account is PA or NPA, or there is authority to exclude an account from NPA classification. But as such, the circular doesn't provide anything of that sort. Now, as far as provisioning is concerned, a provision on asset should be made on the basis of classification of the asset. And when you talk about classification, as far as NPA accounts are concerned, then there are additional factors which will be relevant. First is that the period for which the account has remained into NPA category, that is first and foremost thing, because that will decide whether it is a substandard asset, D1 asset, D2 or D3 asset. Then the second part is that you need to verify as to what is whether the security is available, and if the security is available, what is the realizable value of that, and based on that the provisioning will be made on a particular borrower account. Broadly, you can divide assets into two types. One is standard asset, also called as performing asset, and another one is non-performing asset. The easiest definition of standard asset is that any account which is not a non-performing account, you can call it as a performing account. Or the other definition, which is more relevant, is that this is a type of account which do not carry a risk which is more than normal banking risk. And as compared to that, a non-performing asset is an account which carries a risk which is higher than normal banking risk. Now, what is a banking risk? Banking risk is a normal risk which is there in any lending and borrowing business. So whenever you anyone or any entity is in a lending business, there is a risk of losing that particular principal portion. Now, whenever you are having a higher risk as compared to a normal lending risk, it is called as higher risk, and it will be classified as non-performing asset. Now, let me just give you a couple of examples. For example, you are having an account wherein the advance is granted against the strength of a primary security, which is having a, let's say it's a immovable property having a value of say 10 crores. Now, subsequently, when a second valuation is done, maybe after a year or maybe after 2 years, the security value, that is the immovable security value, has deteriorated beyond 50%. So let's say the value is now 4.5 crores as per the valuation report. Now here you are having a deterioration in value of security. So in that case, even though otherwise the account is normal, otherwise the account is within the drawing power or it's not overdrawn also, but still, since there is a higher risk which is involved because of deterioration of value of the security, then in that case, the account will get classified as NPA. So it's not always that NPA will be only based on 90 days criteria or something related to the lacunae in repayment or something just because of overdue portion, it will become NPA. It can become NPA even in other circumstances also. Another peculiarity of non-performing asset is that these are the assets which have ceased to generate income for the bank. So this is a broad classification or basic class, differentiation between standard asset and non-performing assets. Now let's start one by one about what is the criteria of NPA based on type of advances. So we'll start with the term loan. As far as term loan is concerned, in case of term loan, if your interest or installment, if it remains overdue for a period of more than 90 days, then that account will be turned into NPA account. So that's a normal criteria. Now there is a kind of relaxation available under para 2.1.3 that wherever an account is there where only interest is due, in the sense there is no principal amount which is due in a particular account. So in that case, if the interest due and charged during a particular quarter, if it is not serviced fully within next 90 days, then at the end of that quarter, the account will turn into an NPA account. Let me just give you one example of that. Let's presume that you are having a term loan wherein there is a moratorium period granted for repayment of principal portion for say first 1 year. So in first year, that particular account holder is required to pay only interest which is getting charged on that particular account. So in that case, if interest portion of say October to December quarter, if it is not paid in or not serviced in the next quarter, that is January to March quarter, then that account will be marked as NPA at the end of that particular quarter, that is in the March end. So there is a kind of relaxation given in this para 2.1.3. As far as this para 2.1.3 is concerned, let me just reiterate, it is applicable only in these only in the cases of accounts where the principal amount is not repayable. So typically the accounts will be more in the nature of accounts where the moratorium is there for principal repayment. Otherwise, this para is not really applicable. Another point over here about term loan is that when I'm referring to the first part, that is interest or installment, if it remains overdue for a period of more than 90 days, we need to understand that whenever you are marking an account as NPA, firstly, that account has to be an overdue account. Now, what do you mean by overdue? In case of term loan, you need to compare your ledger balance with the ideal drawing power calendar. And in case if your ledger account balance is more than ideal DP, then only that portion will be considered as overdue. It's not related to interest servicing concept. So it might happen that in a particular account, the account holder has prepaid say 12 installments in advance. And for next say 11 months, he is not paying any installment because he has paid that installment in advance. So if you look at the account, it might appear that the interest is getting debited in the account for say next 11 months, but there is no subsequent credit is there. Still that account will be a PA account for the simple reason that he has prepaid the installments. So his ledger account balance will be naturally below your ideal DP. Since it is below your ideal DP, there is no overdue portion. Once there is no overdue, a term loan account can never become an NPA account. So just keep this particular point in your mind. Now there are a couple of exceptions to this rule. Exception to the rule is that in case of say staff loan, typically the repayment structure is different. So in most of the banks, what they follow the pattern is that in case of staff loan, firstly the principal amount is considered as paid and subsequently the interest is paid. So in that case, you have to go by that repayment structure or repayment schedule. And based on that, if there is a overdue portion beyond 90 days, then that account will get marked as NPA. Then in case of bill purchase and bill discounting facility, the same logic prevails of 90 days. So if a bill which a bank has discounted and if it remains overdue for a period of more than 90 days, then that particular account will be considered as NPA account. As far as agricultural advances are concerned, in case if interest or installment related to the agricultural advance, if it remains overdue for a period of 2 crop seasons with respect to short duration crop and 1 crop season for long duration crop, the account will be marked as NPA. Now, what is the definition of crop season? Crop season is period up to harvesting of crops raised, and that season is determined by SLBC, that is State Level Banking Committee. So you need to refer to the SLBC minutes which define the crop season for each and every crop in that particular state. And based on that, you need to decide whether it is a long duration crop or whether it is a short duration crop. Long duration crops are those wherein the crop season is more than 12 months, and rest all will be considered as short duration crop. Now, as far as agricultural advances are concerned, there is a discretion given to the bankers for reschedulement of agricultural advance in case of natural calamities. So in case of natural calamities, wherever there is a impairment has happened for repayment, repaying capacity of the borrower, there is a discretion given to reschedule the agricultural advances. So firstly, whenever a bank wants to avail this benefit of reschedulement, there are a couple of definitions which one has to refer to. I have just given the references of a couple of circulars besides 2018 circular, which is there for natural calamity. So 23rd April 2015 circular defines what is a farm credit. So firstly, whenever a bank wants to avail this benefit, firstly it has to confirm that whether that particular borrower account fulfills the conditions which are given in the farm credit definition. Having said that, the next condition is that there are 12 natural calamities which have been defined. So as far as the natural calamity is concerned, your natural calamity which has happened has to be one of those 12 instances which have been given. And what RBI is prescribed under this circular is that RBI is talking about institutional framework which the bank is supposed to have. In the sense, bank needs to have a blueprint of action plan wherein the adequate delegation of power has been done to the respective divisional managers or zonal managers, so that instantly this benefit can be extended without wasting of any time. And how the natural calamity gets declared is also defined. That wherever the calamity is covering the entire state, SLBC will declare that. And wherever there is only a small portion or a couple of districts which are getting affected by natural calamity, then district consultative committee will define that. As far as declaration of natural calamity is concerned, it's a domain of sovereign. So either a state or central government has to declare that. And another point is that the assessed crop loss has to be at least 33%. Then only you can take benefit of this restructuring circular. In restructuring circular, the RBI has referred to short-term and long-term crops, and based on that, the restructuring benefits are extended. So as far as short-term agricultural loans are concerned, there is one condition actually, and which is a very peculiar condition, that loan should not be overdue at the time of occurrence of natural calamity. So in the sense, any account which is overdue, and friends, here the word used is overdue and not NPA. So even if there is a default of say 1 rupee also, then that loan will not be eligible to take benefit under this particular scheme. Now, presuming that the loan is not overdue at the time of natural calamity occurrence, then in that case, if your crop loss is between 33% to 50%, the repayment period can be extended to the extent of 2 years. And if the crop loss is more than 50%, the extension period granted is 5 years. Now, these 2 years and 5 years, it will include a minimum moratorium period of 1 year. Now, here, what has been defined is a moratorium period of at least 1 year. So it doesn't talk about only 1 year. So a bank at its discretion, based on its approved policy, can extend it beyond 1 year also. As far as principal and interest due in the year of natural calamity are concerned, that portion will be converted into a term loan account. So no immediate repayment will be really warranted. And additional collateral security is not supposed to be warranted in this particular case. As far as the long-term agricultural loans are concerned, if only crop is damaged and the productive asset is not damaged, then in that case, a bank can reschedule the installments falling due between the year of natural calamity, and the extension of loan can be granted by 1 year. Willful defaulted installments are not eligible for reschedulement. So it's always a tricky thing to define what is willfully defaulted installments. Payment of interest can be postponed. And as far as productive assets, if they are damaged partially or totally, then the repayment period can be extended to the extent of 5 years. So that is about long-term agricultural loan. One more distinctive factor is that as far as short-term agricultural loans are concerned, in case if the account is overdue, then that becomes ineligible account. But as far as long-term agricultural loans are concerned, all accounts are eligible. So there is no distinctive factor between overdue and not overdue account as far as long-term agricultural advances are concerned. Now, this circular is applicable, to these eligible accounts. But let's presume that if it exceeds the norms which have been given, like in short term, it is considered as 2 years and 5 years based on crop loss. So if any bank exceeds this criteria, then that account will get downgraded. So if you're within the framework of this particular circular, you can retain the class of asset. And even in case of agricultural loans, repeated restructurings are permitted in case of natural calamity affected areas. So everything is permitted. If you're within the norm, you can retain the class. If you exceed that norm, then the downgrading of asset will happen. And these are the benefits, as I said, that you can retain the class of asset. One important thing is that whenever the crop insurance proceeds are issued, firstly, they have to be adjusted against the restructured part of the loan. And in case if any surplus is left out, then it has to be adjusted against the fresh loan which the bank has sanctioned. Let me just take up the queries. Up to 31st December, it was a moratorium period. From December quarter interest, 90 days completed on 31st March 2021. If interest is not served, then how to classify that account? Okay. Let me just give you a hypothetical example. That let's presume that we are talking about October to December quarter, and there is a moratorium period which is granted for principal repayment. So only interest is due on the basis of as and when concept. So let's presume that for October 10,000 rupees interest is debited, November 10,000 rupees interest is debited, and say December 10,000 rupees interest is debited. So in this particular term loan account, 30,000 interest is being debited in the account for the quarter of October to December. So this 30,000 rupees, one possibility is that the entire portion is paid in that quarter itself, that is October to December. So there is no question of anything which is sort of overdue, subsequent to 31st December. But suppose nothing is paid, and in the next quarter, that is January to March quarter, if the repayment is lesser than 30,000 rupees, then that account will turn into an NP account. If it is more than 30,000, then October to December interest will be naturally getting served in the next 90 days period. So the account will become PA account. So that's how it has to be dealt with. Just one request actually, any one of you who are posting queries, you can just post queries marked as to everyone rather than directly messaging to me, so that everyone will be able to see the query also, so that for me, I need not have to repeat the question. I hope Siddhartha ji, I have answered your query. If any further queries there, you can again post the query. Okay, coming back to the presentation, as far as derivative transactions are concerned, in case if overdue portion out of derivative transaction is not paid in next 90 days, that is, it remains unpaid for a period of more than 90 days, then the account will be marked as NPA. As far as liquidity facilities are concerned, typically securitization transactions based lending is concerned, if it remains outstanding, that is overdue for a period of more than 90 days, the account will turn into NPA account. As far as credit card dues are concerned, presuming that the bank is directly providing this facility, for credit card dues, if the minimum amount payable is not paid within 90 days from the next statement date, then that account will be turning into an NPA account. Now let's come to the cash credit part of NPA classification. As far as cash credit account is concerned, or CCOD account is concerned, if the account is out of order, then in that case, the account will be marked as NPA. Now there are three conditions which have been given for out of order status. First one is that if the outstanding balance in a particular account, if it remains continuously in excess of sanction limit or drawing power, whichever is less, for a period of 90 days, that is a consecutive period of more than 90 days, then the account will be turning into an NPA account on 91st day. Second condition is that if there are no credits in the account for a continuous period of 90 days as on the balance sheet date or as on the cutoff date, then that account will turn into an NPA account, even though the account might be within the drawing power. Third condition or third possibility is that if the credits which are there in the account, if they are not sufficient to cover the interest debited in the same period, that is the same quarter, then that particular account will turn into an NPA account. Let's take one example of each of these conditions. All these conditions, if any one of the condition is fulfilled, then the account will be called as out of order and the account will get marked as NPA. First condition is that you have to compare your limit or drawing power, and whichever less will be the criteria. So that whichever less amount, you need to compare with the day end position in an account. And if the day end position is always in excess of your DP or limit, whichever is lower, for a continuous period of 90 days, then the account will turn into NPA. Now, why I'm insisting upon end of the day balance is that it might happen that during the day, that is intraday balance might be below your drawing power or limit, but that will not resolve this issue. You have to go by day end balance. Second example is the case wherein an account might be kind of a inoperative account wherein there is no credit which is coming in the account. So in that case, even though your account might be within the limit, but still the account will turn into an NPA account. Tricky, case. Let me just give you a tricky case, especially about this second condition. Let us presume that in the month of January, the account is having a credit balance. That is, it's in adverse balance. And in February also, it is having adverse balance. And in March, actually, let's say on 30th March, that particular borrower has withdrawn certain amount maybe has issued check out of that account, and the account is turning into a debit balance account for say only 2 days, 30th March and 31st March. Now, in this particular case, technically, since there are no credits in the account in last 90 days, the account will turn into NP account, even though out of 90 days, only 2 days are there wherein the account has gone into debit balance. Let me take another interesting case as far as the third condition is concerned. Now here actually what you need to ensure is that you are comparing the same period for interest debited and credits in the account. So you cannot say that earlier quarter was having surplus credit, so I will use that surplus credit in the next quarter. That is not permissible. So when you are talking about March 2021, you have to compare the last quarter, since it is the last cutoff date quarter. So in the quarter of January to March, let's presume that every quarterly interest which is debited in the account is say 5,000 rupees. So January, February, and March, in all the interest debited is say 15,000. So you have to compare that as compared to 15,000, what is the quantum of credit which is getting hit in that particular account. So if the credit summation is less than 15,000 in that particular quarter, that is January to March quarter, the account will turn into an NP account, even though the account might be within the limit. Now here you need to also keep in mind, here the concept is about coverage of interest and not servicing of interest. So more than 15,000 credit need not be subsequent to the interest which is debited in the account. So it might happen that you have a 20,000 credit entry on say 10th of January. So that is sufficient, because total credit summation has to be compared with the interest, interest debits. So it's not interest servicing concept. I have just given this definition of overdue for quick reference purpose, that what is meant by overdue. So if an amount due to the bank under any credit facility, if it is not paid on the due date which is fixed by the bank, then that will be called as overdue. So that's why I gave you earlier example that wherever there is a prepayment, it cannot be called as overdue, because whenever the due date was fixed by the bank, the borrower has paid that amount to you much prior to due date. So in that case, the account will not be called as overdue. So just to compare actually between term loan and CCOD facilities. So as far as term loans are concerned, the first criteria is that your term loan has to be overdue, and then only 90 days criteria will be adopted. As far as, and mind you that no concept of interest servicing is there as far as term loan is concerned. As far as CCOD is concerned, 90 days continuously ordering overdrawn criteria is there, similar to you can say overdue criteria. But there are two more criteria there which are not relevant with the overdue concept. So it's more about whether your account is operative or not, or where the sufficient credits are there in the account or not. So just keep these both things in mind. And as far as interest servicing is concerned, interest servicing concept is absent as far as term loan as well as CCOD facilities are concerned. Interest servicing concept will be relevant only when you mark an account as NPA. So in that case, from as on that date, whatever interest is unserviced, that you have to reverse. So besides that, there is no relevance of unserviced interest portion as far as NPA classification is concerned. Let me just look at the queries before I go further. Out of continuous period of 90 days, is borrower arrange fund for 1 day and withdraw on the next day. Does it satisfy condition of overdue escape? Paragji, what you say is technically right. The sense, say out of 90 days, 89 days are the account is continuously overdrawn, and only on 1 day the account has been brought in limit. Now in this particular case, technically it will escape out of this first condition of out of order status, but possibly depending upon the conduct of account and depending upon the health of that account, an auditor can think of invoking the inherent weakness condition in that particular account. So in the next slide, I will talk about that inherent weakness, and I will again link that with your query. As far as out of order status is concerned, the moment it is within the limit, even for 1 day, that first condition is broken. So it won't be called directly as an NPA account based on out of order status condition. Possibly it might be marked as NPA based on inherent weakness. So I will just stress upon that inherent weakness part whenever that I will come to that slide. The earlier query is about in some of the criteria overdue is for 90 days, whereas in other cases more than 90 days. Actually, there is no such criteria for overdue for 90 days. Let me just look at that. Here also it's more than 90 days. So it's always just to clarify between overdue for 90 days and more than 90 days. Any of these delinquencies which have been specified linked to this 90 days criteria, the account turns into an NPA account only when 91st day arrives. So you have to complete that 90 days criteria, and on 91st day you have to mark that account as NPA. So that's how that 90 days criteria is correlated with the NPA classification. Now there are a couple of instances which RBI has given about accounts with temporary deficiencies. Interestingly, the opening para of these accounts with temporary deficiencies is always a favorite one with most of the bankers, because it talks about a temporary deficiency. And there is one sentence actually which says that the criteria of marking an account into PA NPA should not be merely on the basis of absence of stock statement or overdrawing in the account and all those things. But at the same time, even though that one line is there, which is a kind of a favoring line, subsequently, next two paragraphs, RBI has clearly specified that which are the temporary deficiencies and how a banker and auditor is expected to deal with that. So we'll take both the deficiencies which have been defined. The first deficiency defined is related to stock statement. So what RBI has stated is that in case if you don't receive a stock statement from a large borrower account, because he might be requiring some time to compile the stock statements. So in that case, you can make use of drawing power of a stock statement for next 90 days. After that, you cannot make use of that DP. So subsequently, once you complete subsequent 90 days, then the account will turn into NPA. Just to give you an example, suppose you are having, say, a stock statement of September month. So based on September stock statement, you can use that DP for the purpose of calculation of drawing power for October, November, and December month. Subsequent to that, you cannot make use of this September stock statement. So in January, February, and March, there will not be any DP which is available, and the account will get marked as NPA as on, say, March 8. Suppose you are having a stock statement of, say, October. So using that stock statement, you can use that DP for the month of November, December, and January. After January, you cannot make use of that, but then 90 days period is not getting over. So the account will not be required to be marked as NPA as on March 8. Now, this facility or this kind of, you can say, relaxation is given only for large borrower account and not in case of other borrower accounts. So even though many times the bankers are under the perception that this criteria can be applied to each and every CCOD accounts, that is wrong, because the paragraph itself makes it very clear that this dispensation or relaxation is applicable only for large borrower accounts. So make it a point to verify that wherever the stock statements are not received, maybe for a substantial period, then how the bank is utilizing this particular criteria. Second temporary deficiency is defined related to non-renewal of accounts or non-regulation of accounts, non-regulation of ad hoc limits and non-renewal of regular accounts. Now, if an account is not regularly renewed within 180 days from that due date, then the account will be marked as NPA. Similarly, in case of any ad hoc limits which have been granted to a particular account, if those limits are not neutralized within 180 days, the account will be marked as NPA. Now, as far as non-renewal cases are concerned, there are various arguments which have been made by certain bankers. The argument is that many times the banks are having, they are in the practice of, doing a short review of accounts. Now, whenever you are doing a short review of account, then in that particular case, that can be a replacement for regular renewal. So in such cases, the counting of 180 days should be from the date of original due date and not from the date, when that short review gets over. So let's take a case. For example, if you're having an account which is due for regular renewal as on, say, 30th September, and if that account doesn't get renewed by 31st March, then the account will be marked as NPA. So even if a bank has done a short review of that account for, say, 90 days. So for October to December quarter, there was a short review which was done by the bank. But still the account will be marked as NPA because counting of 180 days should be from the date of original due date for renewal. Yeah, I can see the query of Vidhi Madam about what is the definition of large borrower. Unfortunately, RBI hasn't defined what is meant by large borrower. But at the same time, what RBI has specified is that they have specified the condition as to why that 90 days relaxation is given. Basically, the relaxation was given, in case of large borrower accounts, wherein it takes time to compile the stock statement details. So that was the real purpose. So if that purpose is not, prevalent, or if the purpose itself is, or the condition itself is absent, then this condition doesn't apply. As far as large borrower accounts are concerned, firstly, you can take a call about maybe a threshold of say 5 crores or 10 crores, depending upon the bank's policy. Frankly speaking, practically, banks usually don't define a large borrower account for their own purpose also. At the most, it's only a suggestion from my side. At the most, what we can do is that we can refer to the LFR guidelines of the criteria of advances which you're supposed to review mandatorily, and you can just extend that. And in case if there is a dispute, you can ask the bankers to demonstrate that why it is a large borrower account, is why they're saying that it is a large borrower account. Typically, what I feel is that if you're having an account with a limit of not more than 5 crores, it's very difficult to say that it is a large borrower account. And in most of the cases, you will find that this lacuna of non-submission of stock statement is more about small borrowers, which are below 5 crores or below 2 crores. In fact, large borrower accounts are comparatively better in terms of providing the stock statement. The next query is about Vivekji has asked the query. What about the cases where account is due for renewal long before, but short renewed only at the end of the year? Vivekji, actually, a short review is not a replacement for renewal. So short review is done by the bankers only to ensure that the limit is continued. In the sense, the account can be operatable. And there is no other purpose. In fact, the very reason why short review is done is that there are certain documents which are not submitted by the borrower. So that itself is an indication that there is something amiss. So short renewal, even if the bank is doing, it's their discretion to do a short review, but it is not a replacement to this criteria of non-renewal. So short renewals will not be counted as a renewal, and for non-renewal instances, you have to verify whether regular renewal has taken place. So short renewal will not really help for any bank. So the straight criteria is that if a regular renewal was due on 30th September, and if that account is not regularly renewed, the account will get marked as NPA. A short renewal will not help in that case. Then a few exceptions which RBI has provided where the NPA norms will not apply as such, and there are conditions also which are specified. So any advance, any type of advance which is given against the primary security of term deposit receipts, NSCs, IVPs, KVPs, and surrender value of life insurance policies, then these accounts will not be treated as NPAs, provided the security cover, that is the primary security realizable value, is more than your outstanding balance. So if your outstanding balance is crossing beyond that, normal IRAC norms are applicable. Another point is that income is required to be recognized only to the extent of availability of margin and not beyond that. So let me just give you an example. Suppose you are having a security value of say 100 rupees, and the loan balance say is 99 rupees, and 2 rupees interest is supposed to be charged in that particular account. So what is advised is the bank should charge only 1 rupee interest, and so it will not cross that 100 rupees. And beyond that, the interest might be parked in a shadow account, or in short, it will not be recognized as income. But the account will remain into a PA category, provided that it is not crossing that security value. This dispensation is not available for advance against gold ornaments or any other government security. So the normal norms are applicable over there. As far as central government guaranteed accounts are concerned, even if an account is satisfying the NPA criteria, still the account will be marked as PA, with one condition, that as far as such accounts are concerned, your income recognition will be on cash basis. So the account will be PA, but income recognition will be on realization basis. This dispensation is not available to state government guaranteed accounts. So it's available only for central government guaranteed accounts. let me just look at the query. In case of term loan, we have come across argument for bank authorities when 3 installment remains unpaid, say for 25 into 3, 75,000, and borrower has paid only portion of one EMI, say 10,000. Thereby, one cannot say that 3 full EMIs are outstanding. Can be classified as NPA. I'll come to this point. Just park your query for some time. I will come to this point in a very specific way. This is about partial recovery, so we'll talk about that in detail. As far as classification is concerned, classification is required to be done for borrower in the sense once you mark an account as NPA for a particular borrower account, then all other facilities of that particular borrower will be marked as NPA with a couple of exceptions. First exception is that in case of LCBD facilities, the account will not be marked as NPA. So borrower might be having a LCBD facility, term loan facility, and CCOD facility. So in that particular case, your LCBD will remain into a standard asset category because under LCBD, the exposure is supposed to be taken on the other bank, that is the bank which has issued the LC. So that portion remains as a standard asset, provided that it is not overdue, and all of your other accounts might be marked as NPA. Now, when you mark the account as NPA, it might happen that for CCOD account and term loan account, your NPA dates might be different. That is 91st day might be different. So you have to go by the worst date. So whichever is the lower NPA criteria is there, that is the worst NPA criteria is there, that will prevail. Another exception to this borrower risk classification norm is about the credit facilities extended to PACS and Farmer Service Society, that is FSS, or onward lending arrangement. Under this PACS or FSS, lending arrangement, there are further loans which are sanctioned by PACS and FSS. So in that case, the underlying loans out of that, maybe few loans might turn into NPA and rest of the loans might be PA. So the bank has to demonstrate before you about the data which is available with them, and that particular portion which has remained standard will continue to be a standard, and certain portion might be carved out of that total advance, and only that to that extent the account that portion will be marked as NPA. Let me give you one example. Let's presume that you have given a loan of say to say 100 farmers through Primary Agricultural Credit Society. So everyone has been given 10,000 rupees loan. So 10,000 into 100 is the funding which your bank has made to PACS. Out of that 100 loan, maybe say 5 loans have turned into NPA. So in that case, 5 loans into say 10,000 rupees, just presuming that the amount is same. So only that 50,000 portion will be marked as NPA, and rest entire portion will be continued to be marked as PA. So it will not be really a co-borrower case, but it will be within that you need to carve out that portion. Then as far as consortium advances are concerned, in that case, every member bank will be required to classify the account based on their own record of recoveries. So it will not be consortium wise. It will be based on individual banks' experience. So it might happen that if you are having say 5 member banks for a consortium, out of that maybe say 3 banks might be marking that account as NPA, 2 banks might be marking that account as PA because 90 days criteria is yet to be fulfilled. Only thing is that whenever such issues happen that other consortium banks have already marked that account as NPA and your bank is on the verge of getting into 90 days delinquency, in that case it will be prudent that the auditor will test that account on the basis of whether the account is having an inherent weakness or not. If the auditor feels that there is an inherent weakness, or if there is a deterioration in security value, then you need not have to wait really for 90 days criteria, and you can very well mark that account as NPA. But it's a discretion which is available to the auditor. Other way around, that you can apply the inherent weakness yardstick to such accounts. Then there are 2 straightway classification norms which have been specified by RBI, which are talking about potential threat of recovery in a particular account. And here actually, you don't have to wait for 90 days norms. So even before 90 days delinquencies, the account will be required to be marked as either a doubtful asset category account or maybe even a loss asset category. So which are these 2 norms? First norm is talking about erosion in value. So where you will observe that the realizable value of security is less than 50% of the value which was earlier assessed by that particular bank and which was accepted by the bank or RBI inspector or by statutory auditor. Then if there is an erosion beyond 50%, the account will be straight away classified into a doubtful asset category. You don't have to wait for 90 days norms. You don't have to even see that whether the account is overdue or not. Secondly, in case if the realizable value of a security is less than 10% of outstanding balance in a particular account, then straight away you have to classify that account as a loss asset. Now, this particular criteria is applicable only in those cases wherein it's a secured loan. Now, what is the definition of secured loan? Secured loan is the loan when at the time of sanction, if your sanction limit is supported by at least 10% of security value, then only that account will be called as a secured loan. So in case of any loan wherein the security value is less than 10% at the time of sanction, that account will be called as unsecured loan, and this criteria will not be applicable in those cases. So friends, just remember these two criteria wherein you don't have to wait for 90 days delinquency and the account will be straight away turning into an NPA account. In case of account wherein there is a fraud which has been unearthed, in that case, the bank has to make 100% provision, and that 100% provision will be irrespective of the security value. Now here actually you need to be always careful that suppose a fraud has occurred in a case wherein say underlying security is bank FD, still 100% provision will be required. The only relaxation which RBI has given is that if you have reported this fraud to Reserve Bank of India under the fraud reporting framework, then in that case you can spread that particular portion in next 4 quarters. Otherwise, if it is not reported to RBI, you have to make 100% provision instantly. Okay, I will just take up the query before going further. Okay, what is the value assessed by the bank at the time of sanction or renewal? Okay, if you're Ankit, if you're referring to the secured loan criteria, it is at the time of sanction. So suppose there is a loan which is sanctioned with a sanction limit of say 5 lakhs, and if you are having an underlying security related to that particular loan, which is more than 50,000, that is more than 10%, or at least 10%, that loan will be called as secured loan. So it is at the time of sanction. As far as if you are referring to CCOD facilities, naturally at the time of renewal will be another criteria. So that is about secured unsecured criteria. As far as erosion in value is concerned, that is the first one which you are looking at. In that particular case, erosion in value will be always compared with the last valuation which is done. As compared to last valuation, if there is a erosion beyond 50%, that will be considered as account classifying for straightaway classification in doubtful asset. Let me give you one example. Let's presume that a bank is having a say OD against property loan. The property was firstly valued at say 10 crores, and the bank is having a sanction limit of say 5 crores. Against the sanction limit, the outstanding balance is say 1 crore. And maybe subsequently after 2 years, 3 years, or maybe for another loan, the bank has again revalued that particular security. And now the valuation report is saying that the security value is say 4.5 crores. So naturally, if you compare that 4.5 crores with 10 crores, that is earlier valuation, there is an erosion beyond 50%. Account balance is still 1 crore, so there is a sufficient cushion available, even if 50% margin is removed. But because there is an erosion beyond 50%, the account will get marked as NPA. So it can happen at any point of time. You have to just compare the last valuation with the current valuation. And if the erosion is beyond 50%, it will get marked as NPA. Vidhi ji, you have asked a query. Should we ask for latest valuation report in case of erosion of value from registered value? As far as erosion of value concept is concerned, auditor did not ask for any latest valuation report as such, unless you have a doubt about the original valuation itself. Usually, most of the banks are having a criteria to have a valuation done once in 3 years, based on their internal criteria. So that's the usual revaluations which will be done by the bank. But as an auditor, if you are really skeptical about a particular valuation, if you are having a doubt about valuation, you can very well insist on that to have that valuation carried out once again. And if that proves that it is going beyond 50% of erosion, that case might be a case of fraud wherein the earlier valuation might be jacked up. Because usually 50% erosion is something which is very unusual and not a normal case as such. So we'll come to another criteria about NPA norms, that wherever there is a year-end regulation which is done in a particular account, especially by way of few credit entries which get recorded just before the balance sheet date and the account gets regularized. It's a very common and peculiar case. All of us have been experiencing these cases that throughout the year the account is in problem, account is overdrawn, overdue, and suddenly at the year end everything gets neutralized and the account gets regularized. So in that case, firstly, the auditor should verify, or auditor should rather inquire with the bank as to what is the nature of the solitary entries which are happening in a particular account. In the sense, what is the source of fund? If the source of fund is related to the business receipt, you can very well accept that regularization because it is, it is getting regularized out of genuine business credits. Just to give example of genuine business credit is that, let's presume that there is a long outstanding book debt is there, which gets realized in March end, or maybe in a government contractor's case, the government authorities have released that particular portion of bill which has been submitted long back at the year end, because typically, most of the government agencies release that at the year end to wash out the budgetary provisions which have been made for a particular project. So these are the cases wherein it's a regular realization which is happening out of business receipts. But let's take, talk about other cases. Let's presume that you are having a private limited company which is having delinquencies, and in the year end you observe that there are loans which have been infused by the directors, maybe out of their own funds also, or maybe by way of taking credit in their own, credit facilities in their own name out of against some assets like say gold or something. Now in that particular case, even though the credit entries are regularizing the account, it's not really coming out of genuine business receipts. So in that case, you can very well ask that bank to mark that account as NPA. Now let's talk about certain controversies, which are typically arising out of that. And let's take different cases. So suppose you are having a gold loan, you are having an advance against FD, or maybe FD which is there, which gets encashed and the account gets nullified. Now there might be a finer difference between which FD you are encashing. So let's presume that there is a company which has put in some amount in FDs out of their surplus business receipts which were there in the past, and that particular company encashes that FD. Then that particular credit entry you can always call it as a regular entry because it is out of a normal business transaction. But suppose you are having a case wherein FDs are standing in the name of directors, so they encash that FD in their personal account, introduce this particular fund as a loan in the company. There is always a debatable issue which will arise as to whether this will be called as a regular registration or not. Now here, friend, what you have to verify is that firstly you have to ask yourself whether the account is having an inherent weakness. So let's presume that you are having a case wherein throughout the year you are seeing that the entire installment proceeds are getting paid out of some loans which are introduced by the stakeholders, in the sense that business entity is not having sufficient income generation capacity. So in that case, even though the account might be a regular account, you can always say that there is an inherent weakness which is existing in that particular account. So in that case, you can mark that account as NPA even though the account is otherwise normal. Now here what you can give a kind of a leverage to the bank is that you can ask the bank to evidence or to demonstrate before you that how the account is regularized and whether the business activities of that particular borrower account is carried out in a regular manner or not. So you give an opportunity to be heard to the other party, that is the auditee. If they are able to demonstrate before you that there is inherent weakness which is not really existent, you can accept that. But if you feel that the entire regularization or even the payments which are made throughout the year are not really out of business receipts or business income which is generated, even though the account is normal, you can always say that there is an inherent weakness which is existent in the account. You document that particular criteria also, and you can very well mark that account as NPA. According to me, this is the only area which is a little subjective, in the sense you can have various interpretations drawn. Otherwise, there is nothing like subjectivity which really appears in any NPA classification norms. I will just take query before I go to the next slide. Ankit ji has asked query: ECGC claim has been rejected completely or partially by ECGC, and bank once again files its submission to relook the matter. In this case, shall we remove ECGC coverage portion? Yeah. In this particular case, if ECGC has either completely rejected or partially allowed the claim, bank might again contest the claim to reliquid the matter. as far as we are concerned as an auditor, to the extent of ECGC claim which is sanctioned, presuming that it is partially sanctioned, you presume that ECGC cover only to that extent, because the rest of the portion, even though the bank might have contested, it's a contingent portion now. So that should not be included. So if it is completely rejected, you presume that as if ECGC cover is not there and normal NPA norms will be applicable, because ECGC portion will be waived off. In the sense, it has to be ignored. Now, as far as mandatory valuation is concerned, mandatory valuation norms are applicable only in cases wherein the balance outstanding is beyond 5 crores, that is 5 crores and above, and the account is marked as NPA. So only in those cases, annually the stock audit has to be carried out by external agencies, presuming that there is underlying stock and book dates which are taken as security by the bank. And in case of immovable properties, you have to do the valuation at least once in 3 years by the approved valuers. Now, friends, just keep one thing in mind, that these are the mandatory norms. So the bank might be having their own internal norms, but suppose you are having a case wherein account is NPA with a value of 2 crores. Now, in that case, as per IRAC circular, once in 3 years norms are not applicable. But if your outstanding balance is above 5 crores and if the account is NPA, and if there is no valuation carried out in last 3 years, as an auditor, you have discretion not to consider any valuation attached to that particular property, because then it becomes a violation of mandatory norm. So just keep this thing in mind, that what is mandatory and what is discretionary. Now I'll come to the point about 2 quick questions which I always stress upon as far as partial recoveries and subsequent recoveries are concerned. I think one of the query was related to that. That's why I kept that query parked. Let's take a case wherein at any point of time during the year, there is a term loan account wherein you have an instance wherein number of installments are exceeding 4. In the sense, 90 days overdue criteria is getting completed. Because if it is 3, 90 days will not really get over. So I'm just presuming that it is more than 3. So maybe say 3.01 or 3.2 installments are overdue. Out of that, suppose the bank recovers only 2 installments. And as on year end, the number of installments overdue are 2. So we'll take a hypothetical case. Let's presume that on 13th of December, 4 installments are overdue. Subsequently, certain recoveries are made by the bank, but not to the fullest extent. Only partial recoveries are made. And as on March end, say only 2 installments are overdue. So in such cases, the account will be marked as NPA. The reason being, whenever an account is eligible to be marked as NPA, from that date onwards, you have to apply a norm of NPA upgradation. And what NPA upgradation norm defines is, whatever delinquencies are there in a particular account, in case of term loan or CCOD, if the delinquencies are fully satisfied, in the sense you need to have a single day end wherein there is 0 overdue position, then only a term loan account will get upgraded. So in this particular case, if there is a partial recovery, then in that case the account will not be marked as NPA. Now let me just clarify about that third NPA 3 AMI concept. Let's take a case that 13th is the due date. So as on March end, suppose exactly 3 installments are overdue. So it means that installments which were due on 13th March, 13th February and 13th January are overdue. So from 13th January, 90 days will not get completed as of 31st March. So if only 3 installments are overdue, the account will not really turn into NPA. But if 4th installment is overdue, even partially, the account will be naturally NPA. And NPA monitoring and marking is a continuous process. So it's nothing like month-end position or quarter-end position which has to be taken into account. Wherever account turns NPA, or wherever an account is fulfilling the criteria of NPA classification, that is the date which will be presumed to be an NPA date. Subsequently, upgradation norms will apply. Another typical case. Okay, before that, let me just take out the query. Paragji has asked a query, so let me just first read the query. Borrower deposits cash saying sources are sales revenue for 1 day whenever NPA threshold is to hit. In such scenario, ideally we should ask bank to obtain GST returns, reconcile cash source. given time frame of audit, if we do not get GST return and the bank does not agree classification of NPA, can branch auditor disclose the fact without clarifying as NPA? In fact, Paragji, I will. I am having a little different view. See, the time frame which is given for statutory audit applies to both actually, bankers as well as auditors. So you give an opportunity to produce before you the evidences about any doubts which you are having about NPA classification. So ideally, what I will suggest is, whenever such instances occur, like suddenly he deposits cash in the account and you are a little skeptical about the source of that. Bank is saying that it is out of sale proceeds. You can ask that particular banker in writing, maybe by email or maybe by submitting a letter, saying that you require GST returns to verify that whether that particular fellow is having a turnover of that amount or not. If the bank fails to give you that evidence, you qualify that account and state it as NPA by saying that the data or the required data was not made available to you by the bank. So instead of giving a leverage for non-submission of documents to you, it has to be other way around. So the bank needs to produce before you the evidence about why there is no inherent weakness in the account, and it's not the other way around. You need not have to prove that. So I think I have addressed your query, Paragji. If you are having a different view, you can again post the query. Okay. Then in case of accounts which typically get regularized after the year end, or maybe during the audit process, but before signing of balance sheet. Now, it's a very favorite argument, amongst the bankers that even if an account is marked as NPA as on say 31st March, in the sense say on 31st March, there is a CCOD account which was continuously overdrawn for say 100 days. Or maybe we are having a term loan account which is having 4 installments which are in arrears as on 31st March. Subsequently, before you sign off your report, say on 10th of April, you are signing the report. So prior to that, that particular account is say regularized, or maybe the account is closed. We'll take both the cases. Now, in this case also, you cannot really upgrade any account because what you are signing is as on 31st March 2021 position. Whatever happens after that will relate in the next financial year. It is not your prerogative to even look at that. What you can look at that is, if an account is, the state of account or the conduct of account is worsening in the subsequent period, you can say that there is an inherent weakness which is witnessed in the subsequent period also, and you can mark that account as NPA, but not vice versa. Now here actually, in case if anyone argues with you, you can firstly tell him that events occurring after the date of balance sheet, as it is defined in AS4, really doesn't cover this scenario, because wherever the account gets regularized after year end, it's a normal banking transaction. There is nothing extraordinary about that, and it is not event occurring after the date of balance sheet. That is the first thing. Secondly, presuming that this concept is followed. Firstly, this concept is nowhere in existent in IRAC circular. Secondly, let's presume that 10th April is the date on which you are signing the balance sheet. Then if you want to upgrade such accounts on this, this absurd criteria, then by this same absurdity, you need to also include those accounts which are fulfilling 90 days norms during the period of 1st April till 10th April, which naturally no one will do, because then otherwise it will become an endless thing. Because suppose the balance sheet is getting signed on say 30th April, you cannot keep on changing the status of account till 30th April. So there has to be a cutoff, and cutoff date will be always a balance sheet date. So subsequent regulations or partial regulations are not permitted. You need to see a position of account as on 31st March and take a call. There is no relaxation which an auditor can really give to any bank as far as these questions are concerned. I will just take a query. Before that, I will just draw your attention to 2 paragraphs which are of paramount importance. First is paragraph 4.2.5, which talks about recovery of arrears. So it says that arrears of interest and principals, if they are paid by the borrower, which are in case of accounts which are marked as NPA, then it will not be treated as NPA and it will be classified as standard. So the arrears are required to be paid off. Secondly, there is a paragraph 4.2.2, which gives a period of 30 days to settle the doubts in asset classification. So these 30 days criteria are not about, they are not talking about subsequent recoveries. They are more about settling the doubts in asset classification. So suppose you are having an inherent weakness, doubt in a particular account. So the bank can settle that doubt in next period so that they can produce evidence before you in next 30 days period. but it is not talking about any regularization which is permitted. So just pay attention to both the paras, and meanwhile, let me just take out the queries. Ankit ji had said that because Supreme Court judgment about status quo for declaring NPA from 31st August, as a statutory branch auditor, shall we classify accounts as NPA and report to SC as full account for required provision at HOY passing MOC? Ankit ji, I will just give a response to this query when we come out or when we are discussing about the Supreme Court order. But I will just like to rectify what you have stated. Supreme Court order nowhere has stated that it is a status quo position. Supreme Court order says that bank should not declare any account as NPA. There is a difference between declaration of account as NPA and status quo position. So we'll just deliberate about that particular wording which have been used by the Honorable Supreme Court. Should auditor consider erosion in account for classification purpose? Kunja Bihari ji, I presume that you are talking about the security value. So security value we already discussed. I'm not getting the point about erosion in account. So you can just elaborate. You can just post that query little elaborately so that I can answer that query. Partial recovery in term loan of say only portion of one EMI should be considered and we should not classify it as NPA. No. In case if there is a partial recovery, presuming that the account has already hit the NPA norm, that is, it has crossed more than 3 installments norm, then the account will not be considered as PA because of partial recovery. Partial recovery is not a solution. Entire recovery is the only way to upgrade an account. Okay, erosion after the balance sheet date. See, if there is a erosion after balance sheet date, you have to firstly see that what is the nature of erosion. In the sense, presuming that there is a valuation report dated say 5th April 2021, and it is giving you an erosion of more than 50%, you can very well take that into account and classify that account as NPA, because in 5 days, the erosion cannot happen to the extent of 50%. So unless there is a circumstances because of which erosion has happened subsequent to balance sheet date, then only you can think of ignoring it, but otherwise you have to factor in that. Because it's only a valuation date, and typically these cases will not be really there. Usually bankers will always have a security value as far as statutory audit is concerned, security value derived as on March end, even though the date of valuation report might be say in the first week of April. But to answer your query, if there is a erosion even in after the balance sheet date, it's better to factor in that because there will not be any substantial change in value in that next 4 to 5 days. Okay, now we will come to firstly we'll talk about relief which has been granted to MSME borrowers, and then we'll talk about COVID-19 related circulars which have been issued. Now, as far as relief to MSME borrowers are concerned, just to give a little background, the first circular got issued on 7th February 2018. It gave a relief of one-time restructuring to MSME advances, that is advances given to MSME borrowers, and in all these circulars, there is a cutoff date mentioned. That cutoff date talks about that account to be a standard account on that date. So it's an eligibility criteria. So each circular has a different eligibility cutoff date for account status as performing. So the 7th February 2018 circular was having a cutoff date of 31st August 2017. 6th June circular was kind of extension to that earlier circular. So not really major changes which really occurred through that circular. Then we had 1st January 2019 circular where the scheme was extended till 31st March 2020. Cutoff date was given as 1st January 2019. Then we had 11th February 2020 circular wherein the scheme got extended till for implementation. The date was extended to 31st December 2020. And the cutoff date was 1st January 2020. Then there was a circular on 6th August 2020 wherein the scheme got extended to 31st March 2021. And the cutoff date given was 1st March 2020. Sorry, there is a printing mistake. So just rectify at your end. It's 1st March 2020 and not 1st March 2021. Now let's talk about what is really there in that circular. So I'm just taking the last circular, that is 6th August 2020 circular. See, all these circulars are in continuation to earlier circular. So I will suggest that whenever you are referring to 6th of the circular, keep other circulars also handy with you, because most of the conditions are prescribed over there. So the circular is a one-time relaxation given. So a MSME borrower can avail this relief only once. So under any of the circular, if he has already availed this restructuring benefit, he cannot again avail that under 6th of the circular. As far as eligibility criteria is concerned, the aggregate exposure, which will include fund-based as well as non-fund-based exposure to the banks and NBFCs, has to be within 25 crores as on 1st March 2020. So that is the first criteria. Now here RBI is talking about exposure and not balance outstanding. So you have to refer to the limits and not really the balance outstanding. And friends, when you are referring to the limits, non-fund based limits will be also factored in, and at times it might happen that the 25 crores will get exceeded. Second condition is that borrower account should be a standard account as on 1st March 2020, and till the date of implementation of restructuring, it has to remain in standard asset category. In case if you see an account which otherwise would have been marked as NPA, but the bank has not marked that account as PA, then in that case it will become ineligible. And in case of account which was considered as NPA as on say 1st March 2020, and subsequently it might have got upgraded, but still that account will be ineligible. So the criteria is that the account has to be in PA account as on 1st March. If the account is NPA on 1st March, even though the entire outstanding is repaid by that particular borrower, the account will not be eligible to take that benefit under MSME borrower scheme. Thirdly, the borrower entity should be registered under MSME as on the date of implementation of restructuring, except for those wherein GST registration is not mandatorily applicable. Restructuring of borrower account has to be implemented on or before 31st March 2021. And apparently, if you see the circular, there is no criteria which has been defined as far as number of years for which the restructuring or reschedulement can happen. Practically, what will happen is once an account is eligible to be restructured or rescheduled, then how to restructure or reschedule is dependent upon the discretion available with the bank. So as an auditor, you should always refer to the bank's approved policy about MSME restructuring, and based on those criteria, the bank can go for restructuring. But as such, there is no upper cap about how many number of years the account is required to be rescheduled. As far as asset classification norms are concerned, retention of class is permitted. So even though the account might slip into NPA category between say 2nd March to till date of implementation, in that case, the account will be again taken as a standard asset category. So you can retain the class of asset. As far as provisioning requirement is concerned, additional provision is required to be made at 5%, and it is required to be retained as it is till end of specified period or account which is demonstrating a satisfactory performance. What is meant by satisfactory performance is that in case of an account, you need to have that 1 year period which has to be reviewed for satisfactory performance. That 1 year period will start from the date when first installment or interest is due. So let's presume that you have given 6 months moratorium period. So after 6 months moratorium period, whenever the first installment is due, from that 1 year you have to count. During that 1 year lookout period, if any overdue portion is there, which is overdue for a period of more than 30 days, then it will not be stated as demonstrated a satisfactory performance, and the provision will continue. The account will be still into PA category, but the provision reversal benefit will not be applicable. If the account is never overdue beyond 30 days period for 1 year, you can reverse that provision. As I earlier stated, any account which was earlier restructured under MSME is not eligible for restructuring. And post restructuring, normal NPA norms are applicable based on the revised repayment schedules in case of this MSME restructured accounts. Disclosure will be required in notes on accounts as far as number of restructured accounts are concerned. Number of accounts and amount should be stated. If the restructured account is downgraded as NPA subsequent to restructured, then it will be eligible for upgradation based on satisfactory performance criteria during the specified period. So everything, rest of things remain same. So let me just look at the queries before we start with COVID-19 circular. Okay, we have already answered the query. There is no query. Okay. Now we'll start with the first circular, that is 27 March 2020 circular. It's not really directly applicable for this audit, and I'm sure that most of you must have gone through that in March 2020 audit itself. But I'm taking up this circular for the simple reason that all these circulars are linked with each other. So I thought that it's better that we run through all the COVID-19 related circulars. Now, as far as this 27 March circular is concerned, the purpose of issuance of circular, as it was stated in the circular itself, is to mitigate the burden of debt servicing brought about by the disruption on account of COVID-19 pandemic, and it was to ensure continuity of a viable business. So that was the whole purpose. The relief was provided into three parts. One was reschedulement of payment was permitted for term loan and working capital limits. Second relief was in the form of easing of working capital finances. And third one was a kind of relaxation given from classification norms. Now we'll see all these three reliefs one by one. So let's start with the first one about term loans. Now term loan, RBI has defined that term loan will include all EMI based loans, all interest principal repayment based loans, all bullet payment based loans, and all even the credit card dues will be considered as term loans. So what is the relief which has been granted? The relief is that an eligible account is the account which has got hit by COVID-19 pandemic. So any account which is affected by COVID-19 pandemic is eligible for that. So what is the relief? The relief is in the form of permission to grant a moratorium period of 3 months for payment of all installments to all types of term loans which are falling due between 1st March till 31st May. So in this 90 days period, if any installment is falling due, that can be postponed. In the sense, there will be a moratorium period of 3 months which will be granted. So no installment will be considered as due in that particular period. And accordingly, you have to extend the residual tenure also. So suppose 3 months moratorium is granted, the remaining residual tenure will also get extended by 3 months period. So that was the relief which was granted. As far as working capital facilities are concerned, which will exclude LCBD facilities, the relief granted was in the form of permission to defer the recovery of interest, which was applied during the period of March to May. In the sense that portion of interest, which is getting debited in the account, one can loosely say that it is accrued but not due. But technically, what I will say is that it is accrued and due, but only thing is that there is a dispensation given for repayment. So the repayment period is getting extended. And naturally, this will impact your out of order status also, because there is no interest which is considered as due. So your first two criteria is about interest servicing and this criteria of having credits more than interest summation will not be really applicable. Now the second criteria or second you can say relaxation was given in terms of easing of working capital finance. Now this was given in two forms. One is that circular gave a discretion to the lending institutions regarding reduction in the margin. It gave a relaxation, or it permitted the banks to reassess the working capital cycles till the period of 31st May. So what it means is it can reduce the margin. So maybe earlier the margin was at 25%, a bank can reduce that to say 10%. So that is possible. Second relaxation is assessing working capital cycle. So maybe earlier the bank was granting working capital finance to the extent of 90 days of dates. Bank can say that now we are granting up to say 120 days or 180 days. So that is possible. This relief will be only to the extent of calculation of DP as such, and not really beyond that. Another point is that the bank were permitted to give additional finances also. So that was additional discretion which was given. Secondly, based on these relief which have been granted, RBI stated that it will not be considered as a concession. And since it will not be considered as a concession, then in that case, downgrading requirement will not really apply. Now, this circular as such didn't provided any relaxation in NPA norms. That came, the relaxation in NPA norms came in 17th April circular. Now, few points, before we move on to 17th April circular, whether this circular is really applicable to borrowers which are affected by COVID-19. As per the circular wording, that's what the circular is meant for. So as an auditor, you need to verify whether the bank is having sufficient documentation on the record to prove that the particular borrower is affected because of COVID-19 pandemic. So that is first requirement. Second thing is that, second question actually, is that whether the circular will be applicable to all borrower accounts or whether it is confined to only a particular borrower which has opted for availing the scheme. Now here you have to verify that what was the bank has adopted as a policy. See, many banks have adopted a policy wherein it was a kind of a benefit which was extended to all borrower accounts except those borrowers which have denied to take this particular concession. So based on bank's criteria, you need to see that how this criteria was adopted or how the borrowers were benefited. Now, presuming that a particular borrower doesn't want to avail this particular relief, then in that case, normal IRAC norms were applicable. So no concessional treatment was supposed to be given. So you need to verify how the master data of the bank is really changed or is capable of handling these cases. Now, because of this extension, what has happened is that because of this extension, that interest which was getting debited in that particular account, naturally that will have an impact on change in EMI. Because what RBI stated is that to the extent of this moratorium granted for repayment of term loan installments, you will extend the repayment period. So suppose 3 months is the moratorium granted, 3 months extension will be there. But because of that 3 months moratorium interest, which will be getting hit in that particular account, the EMI amount will undergo change. So again, you need to refer to the bank's policy as to how that has been dealt with. Another point is that there is no specific criteria which is given as far as drawing power calculation is concerned. So it is left to the discretion of the banks. So whether the book date should be considered up to 120 days, 180 days, 360 days, 365 days, that is up to the bank. Now, there is one peculiar doubt which I'm having in my mind. See, this circular got adopted from, for the period from 1st March till 31st May. Can we really say that, say, a bank adopts a policy to grant, book dates up to, say, 180 days? Practically, till February end, that relaxation is not really applicable. So, ideally, the bank should give that relaxation in a stage-wise manner. Let's presume that account is a book date is there which is outstanding for say 90 days as on say February 8. So maybe in March and you can say that up to 120 days are permitted. Maybe after 1 month, say in April you can say 150 days. Later on you can say 180 days, something of that sort. But suppose there is a book date which is outstanding for say 120 days as on February end itself. So anyway it was not eligible. Can a bank really cover up these book dates? That is something which is little difficult to digest. So as an auditor, you need to review that how the bank has adopted this relaxation. Okay, let me just check up the query. Changes in repayment schedule in any retail loan like vehicle loan, home loans will be treated as restructured account. No. See, if there is if the relaxation is adopted by way of 27 March circular, it will not be treated as restructured account and it will be considered as a normal relaxation given. Account will be continued to be marked as PA. No restructuring as such will be considered. The next circular which got issued was 17th April 2020 circular, and this was a circular which gave a relaxation from asset classification and provisioning norms. So it provided a relaxation to those accounts which have been really getting hit by COVID-19 pandemic. But let me just stress upon one point which I missed out. 27 March circular per se is applicable to all borrower accounts. So whether the account is PA or NPA, it really doesn't matter. It was made applicable to all borrower accounts, with maybe an exception you can say for fraud-related accounts, wherein such dispensations are never allowed. So it might happen that you have an NP account which was having 4 installments overdue on say February 2020. He has availed that 3 months moratorium period, and during that 3 months moratorium period, the earlier 4 installments are repaid. So the account will be very much eligible for upgradation. So just keep this thing in mind. Now let's come back to 17th April 2020 circular, wherein the relief was granted for asset classification also for provisioning on those assets. Now, what is the relief which was granted? Firstly, let's look at the eligible account. An account, say in case of term loan account, if the term loan account is standard as on 29th February, those accounts will be eligible for this relief. And secondly, the account should have availed the moratorium period under 27 March circular. So if both conditions are fulfilled, then only this relief under this 17th April circular is available. Now, what is the relief? Relief is limited only to the extent of calculation of delinquency with respect to asset classification norms, wherein you need to exclude the period for which the moratorium period has been availed by that particular borrower account. Just to put it in simple words, let's presume that 3 months moratorium is availed. And as on 29th February, the delinquency is there for say 70 days. So the balance 20 days will get counted subsequent to this moratorium period getting over. So after May end, that subsequent 20 days period will be counted. So it will be a kind of counting holiday for all those accounts which have availed moratorium period. Now the other point is that this relief will not be available for accounts wherein repayment moratorium is not availed. So the normal norms will apply. And wherein this relief is granted, naturally upgradation of account is possible. As I already stated that if you're having an account wherein 4 installments were overdue, moratorium is availed, the account can get upgraded during this particular period. As far as working capital facilities are concerned, all working capital finances facilities are eligible, which are standard as on 29th February. Relief granted is in term of counting of days for out of order status. So the intervening period of 1st March till 31st May, the out of order status will be standstill. So it's a kind of a standstill clause which will be applicable. So the point is that the account will not get deteriorated during this period, but account can very well get upgraded, during this particular intervening period. Now, as far as provisioning is concerned, what RBI specified is that in case if the account would otherwise would have got marked as NPA, but because of this dispensation, the account is retaining the class as PA, then in that case, you have to make a prudential provision of 10%. So if you're having an account which otherwise would have marked as NPA on 31st March, you have to make 5% provision on 31st March, 5% in June. So in all, you have to make 10% provision. And most important thing is that the provision is required to be made account wise and not borrower wise. So that is a very important point which one has to keep in mind. So let's take few examples to make this point clear. Let's presume that we are having an account which is having an installment overdue from 15 December. Now in that case, as on 29th February 2020, 15 December 2019, there is a mistyping error. So in this account, the account is still a PA account because 90 days are not completed as on 29th February. But by the end of a year, that is 31st March 2020, the account would otherwise would have been marked as NPA. So in that case, since you are availing the benefit under this particular scheme of retaining the class of asset, you have to make 5% provision in March, 5% provision in June. Let's take a case wherein say from 15 January, the installments are overdue. So in that case, from 15 January, 90 days are not really getting completed on 31st March. So on 31st March, there is no provision which is required. But by June end, 90 days criteria will get fulfilled and you have to make 10% provision. Now here, what you need to verify is that whether an account will be eligible for 90 days criteria, presuming that the moratorium is not available. Only in those cases you have to make this provision. So it is a kind of a prudential provision for those accounts which otherwise would have been marked as NPA. But in a normal case, if that 4 installment or 90-day delinquency criteria is not getting fulfilled, but the moratorium is availed, in that case, naturally the provisioning requirement is not there. It might also happen that in March end, that particular account is required to be made a provision of 5%, but in subsequent period, there is an amount which has been repaid by that particular borrower. So as on June end, the account would otherwise will not be really considered as NPA, even though moratorium was not there. Then in that case, provisioning requirement is not there. Other matters are like how to make the usage of that provision. Naturally, these will not really happen at branch level, but just to tell you in nutshell, this 5% and 5%, that is in all 10% provision which is expected by June end, either you can reverse that provision subsequently if the account is otherwise a standard account as on say 31st March 2021, In case if the account gets slipped into NPA category, this 10% provision can be used for BDDR provision. Other considerations, as I already stated, there is no bar on upgradation of account during this intervening period. And in case of existent NPA accounts on 29th February, normal NPA norms and aging criteria will be applicable. So aging of NPA is not really getting hampered because of this 17th April circular. Documentation circular will be documentation policy requirement will be based on the bank's approved policy, and you need to verify that whether the CBS is really well equipped to take care of all these RBI regulatory relief measures. So just verify the master data as to how the bank is really adopting that part. As far as CCOD accounts are concerned, verify that how the interest deferment is really accounted for by the bank and whether there is any impact on capital adequacy calculations because of this separate account being maintained for CCOD facilities. As far as prudential framework for resolution of stress asset is concerned, that is June 19th circular is concerned, there was a relaxation provided that when you are counting review period of 30 days, this 90 days period was supposed to be excluded. That is 1st March till 31st March period will be excluded from the counting of review period of 30 days. Similarly, that 180 days period will also exclude this 90 days period. So it's in the same fashion the relief was extended. Okay, now before we go further to 23rd May 2020 circular, let me just look at the queries. Paragji has asked a query. Term loan and CC facilities are secured by properties, book debt, stock, etc. There was a crash in stock market by say 10% or so on many days, and by the March end it's back to original. But the other assets classes are not. How do auditors assess the value of securities post May 2020 moratorium if the bank did not perform valuation exercise? Market condition has been such that assess value cannot be same till March 21. I'm presuming that you are talking about stock values or underlying stock. Okay, see, as far as drawing power calculation is concerned, since it is you're talking about CCOD facilities, wherein CC is backed by book debts and stocks, and maybe OD facilities are backed by properties. If there is a crash in the market, you can ask the bank to go for a valuation exercise, and based on that, the DP can be revoked. When the provision of April 17 circular provision will be reversed? Yeah, I will just take you back to the earlier circular. See, as far as the provisioning is concerned, firstly, the provision can be used for any slippages which are there. In case of any other account also which is getting slipped, even there you can use it for that purpose. Or in all other cases, subsequently, the relief has been withdrawn. So after that, account, if it remains into a PA category, the provision will get reversed. So if you're talking about March 2021, either the provision will be used for BDDR or it will get reversed. And the provision can be used for even any other account also. In the sense, suppose you are having 10 accounts, one account provision can be used for any other account. So as on 31st March 2021, this provision is reversible to either BDDR, in the sense routing that provision through P&L and making a BDDR provision, or you can simply reverse that provision if BDDR requirement is not there. Gopalji, it's good to see that you are here. I was not aware that you are in the audience. I hope that I have answered your query. So just post the query in case if any further queries there about the 17th April circular. Now we'll come to the 23rd May 2020 circular. As far as this 23rd May circular is concerned, it was a kind of continuation of earlier relief which was granted by way of 27th March 2020 and 17th April 2020 circular. So on the similar lines, the circular extended the benefit. So for term loan, it said that the moratorium period can be further extended by 3 months. That is, it will get extended to 31st August 2020. So now in all, we are having 6 months moratorium period. In case of working capital finance, the interest which is debited in the account from 1st March to 31st August, the interest due date will be getting deferred till 31st August 2020. And interestingly, under this circular, there was an option given to convert the accumulated interest into funded interest term loan part. Now, friends, that's where the real interesting, or you can say subjective part, really begins. See, if you read the circular, what the circular says, in the first part, it says that the interest deferment benefit will be extended till 31st August 2020. What it means is the interest for the month of March, April, May, June, July, and August, that will be considered as due on 31st August 2020. So as far as repayment date for those interests is concerned, from March till August, the repayment date will be considered as 31st August 2020. So that is first part. Now, second part is little different than this first part. Second part, what it says is, there is an option which is given. Again, to repeat, it says that there is an option given. So it's not a mandatory thing. What is the option given? The option given is to convert the interest from the month of March till August into, that is the accumulated portion of that interest, into a funded interest term loan portion. And the paragraph ends there itself. Now, friends, the real challenge is that if you convert an interest into a funded interest term loan portion, presuming that there is no such dispensation given in this 23rd May circular, you have to refer to the funded interest term loan accounting treatment, which is given in IRAC circular. What the IRAC circular says? IRAC circular says that whenever you are converting an interest portion into a funded interest term loan portion, you have to make 100% provision against that. And as and when the funded interest term loan is repaid, then you have to recognize the interest to that extent. Now, what is the fundamental concept related to this FITL is that the fundamental concept is that whenever a bank is funding for its own interest income, then in that case, as a conservative policy, income should not be really considered as realized. According to me, my personal view is that the same logic exists over here, because RBI has not given any extension of repayment. What it says is that you can convert that portion into a funded interest term loan facility, and that facility can be made repayable up to 31st March 2021. So if you finally read those lines or read the circular sentences, it doesn't defer that interest repayment period till 31st March. It is giving an option to convert that interest into a separate facility, which is called as FITL facility. And the moment FITL is given, naturally the normal accounting treatment should prevail. Another very very much important point is that, see, FITL facility can always be there for performing assets as well as non-performing assets. So it's not that FITL will be always provided for NPAs. So the more concept is about whether a bank can really recognize the interest based on the funding for that interest which is done by the bank itself or not. So on 31st March, that will be a real challenge as far as income recognition is concerned. So I just thought that I will just draw your attention to this particular point. Okay, then RBI gave that easing of working capital finance facility by way of 23rd May circular also. What it stated, that reduction in margin is again permitted up to 31st August 2020. And in case if you are given an enhancement in drawing power granted or margin relaxation is given, you have to restore it back to normal till 31st March 2021. Another asset exclusion benefit, that is asset classification benefit, was extended till 31st August 2020. So when you are counting 90 days delinquency norm for overdue portion or out of order status portion, you should not count the period between 1st March till 31st August. And from 1st September, you have to start again counting that. So in short, the standstill clause will be there for all performing accounts which were performing as on 29th February 2020, and they will remain in performing asset category till 31st August 2020. Similarly, 23rd May, there was another circular which was about resolution of stress asset. So 30 days review period was extended by further 90 days period. And similarly, 180 days period was also extended by that additional 180 days period between March to August. In short, the period between 1st March till 31st August will not get counted for the purpose of this 30 days or 180 days counting of period. Now we have 6th August 2020 circular, which talks about restructuring, or you can say resolution framework for COVID-19 stress assets. Now this is a circular which is granting relief in the form of restructuring of assets by way of this particular circular, and there are some conditions which have been given in that particular circular. So we'll go step by step and we'll talk in detail about this 6th August circular, which is of paramount importance as far as this 2021 financial year audit is concerned. Now first let's look at which are the ineligible exposures are concerned. So the first ineligible exposure is the in case if you are having a borrower account which is a MSME borrower with an aggregate exposure within 25 crores as on 1st March 2020, then in that case this particular account will not be eligible to take benefit of this 6th August circular. So such accounts you have to refer to, or you have to take benefit under 6th August 2020 MSME circular. So this is the first one. So whenever a bank says that a particular borrower account is restructured under 6th August 2020 circular, first check up whether it is a MSME borrower or not. If the borrower is MSME, you have to go as per MSME relief circular norms. Second ineligible exposure is farm credit. So for farm credit, master directions will only apply. So as far as COVID-19 pandemic is concerned, it is not considered as a natural calamity. So practically for farm credit, even though they might have been getting hit by COVID-19 pandemic, unfortunately, those farm credits have been made ineligible under this 6th August circular. Then loans which have been given to primary agriculture credit societies and FSS for onward lending to agricultural borrowers, those are ineligible. Exposure to lending institutions, those are ineligible. Exposure to central, state or local government bodies, that is ineligible. Exposure to housing finance companies, that is ineligible for this particular benefit. And all staff loans have been excluded from the purpose of this 6th August 2020 circular. So friends, be clear about to whom it will apply. So any account which is not falling under any of these 7 criteria, those accounts are eligible for getting restructured under 6th August circular. Now, what is the eligible criteria? As far as circular is dividing the eligible borrower accounts into 2 parts. One is personal loan, second criteria is other loan. And for both, the norms are little different. So we'll consider about personal loans. First important eligible condition, that for personal loans, the borrowers which are eligible will be only those which are getting affected by pandemic and not otherwise. So the bank has to prove before you that a particular borrower account wherein the restructuring is done in case of personal loan, whether the borrower was getting affected by pandemic or not. Second thing is that, which is again very important, that for implementation of this 6th August circular, that is resolution framework is concerned, a bank has to have a board approved policy. So that is a document which you need to ask to the bank. Third thing is that the reference date for outstanding amount of debt for resolution will be 1st March 2020. And secondly, the account has to be a standard account, and that too, it should not be in default for more than 30 days. In the sense, suppose you are having an account which is under SMA1 or SMA2 category, then this circular benefit is not applicable. Then in that case, if the bank has done a restructuring, the account can be very well restructured. So there is no bar on whether the account should be restructured or not. Only thing is that the asset retention of class benefit will not be applicable in such cases. So the account will get downgraded. But if an account is under SMA 0 category, then in that case, the account can be restructured and still that account will retain the class of asset. Now the borrower accounts will be also required to be standard account as on the date of invocation of resolution. So first criteria what we discussed was, as on 1st March 2020, account should be SMA 0. and on the date of invocation, the account should be a standard account. Now, here actually you can have SMA 0, SMA 1, SMA 2 criteria also. But as on 1st March 2020, it has to be SMA 0 only. Now, what is meant by date of invocation? It is a date on which both borrower and lender are agreeing to proceed with resolution plan. So date of invocation has to be documentedly proved before you as auditor. And what is the last date of invocation? The last date has already lapsed, that is 31st December 2020. And the bank is required to implement the resolution within 90 days from the date of invocation. Now, what is the resolution plan? The possibility is that bank can reschedule the entire payment. So payment can be rescheduled. Bank can convert interest accrued or to be accrued into another credit facility. Moratorium period is possible to the extent of maximum 2 years. So here, friends, bank has to prove that why moratorium period of 2 years is really required for personal loan. So what is expected is that because of COVID-19 pandemic, the personal loan availing borrower should be affected in such a way that the moratorium period was required for him. Just to give an example, one can have a case wherein someone has lost the employment and he is not having any income, earning as of now. So the bank might decide to give a moratorium period of say 1 year, or maybe taking up any employment. So there has to be some criteria about why moratorium period is granted. A bank cannot, sanction moratorium across the board by saying that anyone who is availing personal loan will get a moratorium period of say 6 months, 1 year, 2 years. That is not supposed to be done. It is a period which is stated as maximum period up to which moratorium granting is possible. Fourth one is that moratorium, if it is granted, should be effected immediately upon implementation. So what it means is it has to be prospective and not retrospective. So wherever it is implemented, it will be from the date of implementation onwards. It is not from the date of invocation. Now, as far as implementation is concerned, there are conditions when a resolution plan can be said to be implemented. The first condition is that the entire documentation process has to be completed. Second thing is that the change in terms and conditions of that particular borrower account has to be duly reflected in books of lender. In the sense, your master data has to undergo change. Third thing is that borrower should not be in default with the lenders as per the revised term. That is a natural outcome. Now, in case if there is a breach of condition in implementation, then normal NPA norms will be applicable. So suppose it is a conditional restructuring. If the conditions are not met, then in that case, normal NPA norms will be applicable. Now let's come to the other criteria, that is other than personal loan. So in case of single lender exposure, you will get governed by board approved policy, and based on that, the resolution plan will be implemented. But in case wherein there are multiple lending institutions are there, either under consortium or under multiple lending facilities, then in that case, you can invoke the resolution plan only if 75% of lenders in value terms or 60% of lenders in number terms, that is number of lenders terms, if they agree to invoke the plan, then only this resolution framework can be invoked. So that is a primary condition. Now, when you have to invoke the plan, firstly, it has to be invoked before 31st December 2020. In the sense, these number and these value terms lenders has to agree along with the borrower being agreeing to the terms before 31st December 2020. That is first condition. Second is that it has to be implemented within 180 days from the date of invocation. So practically bankers are having the time to implement by 30th June. Again, moratorium period which is permitted is up to 2 years. Now again, friends, over here it is up to 2 years and not blanketly 2 years. Fourth point is about sanction of additional credit facilities. That is very much permitted. Now, as far as multiple lending institutions are concerned, they need to sign the intercreditors agreement by all the lenders within 30 days from the date of invocation. Otherwise, the invocation will be considered as lapse. Another point is that the circular specifies that there is an expert committee which is formulated, and they will provide the list of parameters, financial parameters, and sector-wise desirable range of parameters to make that account eligible for that resolution plan. Now, this particular committee has published the report, on 7th September 2020. It has given various financial parameters in general and sector specific also. So as an auditor, you need to review that 7th September 2020 parameters which have been published by expert committee, and only those accounts will become eligible to avail this benefit. Now, in case if you are having an aggregate exposure exceeding 1,500 crores, then the weighting of resolution plan will be required to be done by the expert committee also. And in case if you are having a exposure beyond 100 crores, then there has to be an independent credit evaluation carried out by independent credit rating agencies, and that is a mandatory part. If it is not done, then one cannot say that the resolution framework terms and conditions are satisfied. Asset classification and provisioning norms. As far as this resolution framework is concerned, in case if there is additional facility provided between invocation and implementation, that facility will be considered as standard asset only. And after the implementation, it will be co-borrow. The first condition why it is important is it might happen that during the period between invocation and implementation, other facilities might turn into a NPA category, but this additional facility will continue to be a standard asset category. And once implementation is done, the criteria will be co-borrow. Now, wherever there is a slippage happens between invocation and implementation date, then in that case, after implementation, the account can be upgraded to standard asset category. Now, let's take a classic case. Let's suppose the date of invocation is 31st December. You have a period of 180 days for implementation of that resolution plan. So as on 31st March, the implementation is not yet completed. And unfortunately, it is quite possible that even though the resolution plan is invoked, since it is not implemented, till the time normal NPA norms are applicable. So account might turn into NPA as on say 31st March. So then in that particular case, the account should be marked as NPA. Let's presume that on 10th of April, the implementation happens before you have signed off your balance sheet. Still, as on 31st March, the NPA categorization will be same. You cannot upgrade that account, with a backdated effect on 31st March. What will happen is, on the date of implementation, which is say 10th of April 2021, the account will get upgraded because the plan is now implemented. But it will not be a retrospective, it will be a prospective effect. So what is the real benefit? Benefit is to retain the class of asset benefit as on date of invocation of the plan. So that is the real benefit out of this resolution framework. As far as provisioning is concerned, for personal loan, wherever the plan is implemented, then you have to make 10% provision of that, of the amount outstanding, or the provision which is held as on the date of implementation, whichever is higher. Other exposures, the provision is that if the ICA is signed within 30 days, the provision has to be 10%, or a provision held on the date of implementation, whichever is higher. If the integrators agreement gets signed off after 30 days, you have to make 20% provision. So in short, what is minimum required is 10% provision, even though the asset is retaining the class of asset. And friends, let me just remind you of one point. This provision is a standard asset provision. It is like a COVID-19 special provision and not a BDDR provision. So the benefits related to BDDR, like tax benefit or maybe net NPA class, net NPA calculation benefits will not be available as far as these 10% provisions are concerned. As far as reversal of provision is concerned, the circular provides for reversal. So in case of personal loans, whenever half of the half of the amount is repaid, when 20% of the repayment occurs, half of the provision can be repaid. When 30% repayment occurs, the entire provision will get reversed. As far as other provisions are concerned, for other exposures, for signatories to ICA, same like personal loan, 20% if it is repaid, reverse half of the provision, 30% repayment happens, balance half can be reversed. For non-signatories to ICA, it will be same, but normal IRAC provisions will continue to apply. So it will not be dispensed off. As far as performance is concerned, for personal loans, normal IRAC norms will apply. As far as other than personal loans are concerned, that is non-MSME business exposures are concerned, there is a monitoring period, which has been specified. Now, what is the monitoring period? Period between implementation and repayment of 10% of residual amount, subject to minimum 1 year. Now here actually the period will start from the first installment of principal or interest. So suppose there is a moratorium granted, you have to exclude that, and from there you need to count the period of minimum 1 year or 10% of amount which has been repaid back. If there is a default during the monitoring period, which is beyond 30 days, then review period will be triggered off. And if the borrower is in default at the end of review period, you have to downgrade that account to NPA category. And that's where the criteria is little cumbersome, in the sense whenever you are having a default beyond 30 days, there is a possibility that the account might slip into NPA category. Disclosure is concerned, disclosure is normal. There is a format which is prescribed for quarterly and annual disclosures, and credit reporting will be made as restructured. In fact, yesterday on 12th of March, RBI has issued a circular about how to report these cases. So any account which has availed the benefit under COVID-19 restructuring benefit under this resolution framework, in its credit rating or in its credit report, that particular loan will be marked as restructured loan. So restructured under COVID-19 will be the nomenclature which will get added. Just for academic interest, you can refer to yesterday's circular which has been issued by RBI, which talks about this particular nomenclature which has to be given in the data which is provided to these credit rating agencies like CIBIL and all. So this is all about COVID-19 circular. Let me just look at the queries, and then I will go to the next point about other circulars. Okay, Rajesh has asked a query. What evidence should we gather for any borrower being affected by pandemic? So as an auditor, you need not have to worry about that. The banker has to give evidence before you that the borrower was affected by pandemic. So the evidence should be to your satisfaction as an auditor. So you don't have to gather anything. Bank has to prove before you. Rajesh had posted a query. Effects of all these circulars of COVID-19 to affected borrowers would be at the branch level, manually in master and accounts data, or will it be in the form of central level? Whether separate data will be available for branch auditor, that in these loan accounts COVID-19 circulars are given effect, and also provisioning, how we should verify. See, all the banks are maintaining the data about all the resolution framework benefited accounts. So the data will be available to you at the branch level. And typically most of the CPS are having a parameterization, wherein wherever there is a restructuring which is happening, you get a separate report for that. So you have to gather that report, and using that report, you have to move on. Just I will reiterate one point. If you notice, actually, the 6th August circular is unique in the sense that RBI for the first time just specified that in the books of account also the terms and conditions should be specified. So unless there is a change made in master data, the implementation doesn't get over. So it will be only in those cases where the master data is changed. So you can draw the reports from CBS system wherever the master data is changed, and you can also ask for the accounts which have been restructured in the branch. One more thing as a precaution, what I will suggest is you ask the bank beforehand that to give you a list of accounts which have been restructured under this COVID-19 resolution framework. So take it as a kind of a MRN, so that you are protected from possibilities of any account getting skipped from your end in case of any manually restructured account or wherever the master data is not updated. Any other query about COVID-19? Okay. In case of any queries, you can add those queries. Meanwhile, I will take up few circulars which are of prime importance, which affect the current year's audit. There is a circular on 21st August 2020, which talks about ad hoc short reviews and renewals of credit facilities. Now, the best part about this 21st August 2020 circular is that when we were discussing earlier about the temporary deficiencies, we are discussing about these ad hoc and short reviews. Fortunately, for the first time, RBI has felt it necessary to issue a circular to give more clarity about that, because there has been always a kind of debate which used to happen between the auditors and the bankers Bankers were saying that short review is also a renewal, kind of a renewal. So 180 days counting should be after the expiry of that ad hoc renewal or short reviews. Auditors were of the view that 180 days counting will be from the date when that particular facility was due for renewal. Now, RBI has put an end by way of giving a clarificatory circular. Rather, the circular is kind of a stricture which is there on the bankers. So the stand which the auditors were taken and the stand which is already there in the bank audit guidance note also, that is it's a kind of a reiteration which is done by this 21st August circular. There is second circular on 21st August 2020, which is talking about new definition of MSME, and it's not really a new definition, but it is adopting the definition by MSME Act. So just refer to this 21st August 2020 circular for more clarity about which account should be classified as MSME. So it will give a kind of a additional documentary evidence as to how to classify an account as MSME and non-MSME. Then there is 14 September 2020 circular, and I find this circular a little interesting from different perspective. On one hand, there are RBI regulatory reliefs which have been granted. On 14 September, that Supreme Court interim order was also in place, which stated that the accounts which were not declared as NPA till 31st August 2020 shall not be declared as NPA till further orders. In the background of that, RBI had issued a circular on 14 September 2020 saying that bank has to have an automation of income recognition and asset classification and provisioning processes through their CBS system. And they're referring to 2011 communication. Interestingly, in 2011 communication also the same thing was specified, when it was expected that the CBS will have an automation of IRAC norm implementation. But again, after almost 10 years, RBI is asking the banks to ensure that automation happens before 30th June 2021. Personally, I'm a little skeptical about this particular circular because in 2011, all the banks have stated that they have automation of income recognition norms. Now, the real question is that, can a bank really say that the automation of income recognition is not there in CBS system as on today? If you ask any bank, no one will say that it is not there in place. So everyone is agreeing that it's already automated. At the same time, we as auditors have been witnessing something different. I will, since it's Ahmedabad branch, I will take a little benefit of being very informal with all of you. As far as the automation is concerned, what RBI is expecting is complete automation. What we are foreseeing or what we are experiencing in bank is a partial thing. Most of the banks are having a system of auto identification of account as NPA. They don't have a auto marking of NPA accounts. So what happens is, system throws some exceptional report about which are the accounts which are identified as NPA by the bank, by the system. And then the branch decides about whether to mark that account as NPA or not, or whether not to mark that account as NPA, and some have some remark specified against that. That is something which was never expected. As an auditor, wherever you are doing audit, irrespective of the softwares are throwing exceptional reports wherein system identified NPA accounts are there, but which are not marked as NPA by the bank. So just make use of that report to verify that which are the accounts which are marked as NPA, which are supposed to be marked as NPA. Okay, now we'll come to the real interesting part about Supreme Court order, that is the interim order, which is there on 3rd September 2020. This 3rd September 2020 order, the order is running into 7 pages. First 6 pages are specifying that who is representing whom, and the 7th page really talks about one-liner order. The one-liner order says that the accounts which were not declared NPA till 31st August 2020 shall not be declared NPA till further orders, and the order ends there itself. Now, as far as this order is concerned, I will first talk a little about what kind of banking practices is prevalent rather, what banks have adopted as a practice. Then I will talk about my personal view about the Supreme Court order, and I'm reiterating that is my personal view. So I will appeal to each one of you to think over it and then take a stand. Firstly, let me talk about what the Supreme Court order really says and how the banks have adopted. So as far as Supreme Court interim order is concerned, it is talking about declaration of NPA account. Now, friends, if you see any of the RBI circular, none of the RBI circular is talking about declaration of any account as NPA. It talks about classification of account as NPA. It talks about accounting treatment and BDDR, that is provisioning treatment, which should be followed by the bank. So declaration word is something which is not really prevalent in the RBI circulars as such. Nevertheless, many a times what really happens is Supreme Court judgments are based on what the appellant, what the person argues, or how the relief is sought from the Supreme Court. So let's presume that it was more from declaration point of view. So what the banks have done actually, at least in the quarterly review, and there is a mixed variety of practices. Few banks have stated that based on the Supreme Court order, we will not consider any account as NPA subsequent to 31st August 2020. So all the accounts, there will not be any NPA marking as such. Some banks have stated that we will not mark the account as NPA, but we will make provision. And we will follow the income recognition norms also, as if the accounts were NPA accounts. Few banks have stated that we will be also doing the same practice, but we will make provision, and we will call that provision as a prudential provision. So suppose IRAC norm require 15% provision for a substandard asset. Few banks are saying that we will not make 15% provision. We might make, say, 5% provision. I'm just giving a hypothetical percentage. Now, friends, first thing is that whenever someone says that it is a prudential provision is something which is not lesser than minimum required provision. So if someone says that I will follow IRAC norms for provisioning and income recognition criteria, if you go beyond that, then that is prudential. If you go below that, that is never called as a prudential part. Secondly, leaving aside what it is called, you cannot have a kind of an ad hoc stand which is taken. So if a bank says that they are making provision similar to IRAC norms, but not marking that account as NPA, those banks, what they have done, at least in quarterly review, is that they have disclosed those figures. So what they say, what they have done, they have given a quantification of such accounts in terms of number and in terms of values, that so many number of accounts having so much value, that is balance outstanding, were not marked as NPA based on Supreme Court interim order. But at the same time, as a prudential or as a prudence, the bank has made a provision equivalent to what it would have been made as a provision, presuming that the account would have been marked as NPA. So it's kind of at par provision which is made if the account was NPA. Now there are a couple of issues which will arise out of that. Issue is that firstly, this provision will be never called as a BDDR provision. The reason being, in your books of account, as a bank, if one is I think that I had got disconnected. Let me just again share the presentation. Give me a minute. Okay. Can you hear me and see the share screen? Any one of you can just put that in chat box. Yeah, okay. Thanks a lot. Thanks a lot. Okay, just to continue from where we left. So, if a bank presumes that the income recognition norms are also followed, so what will happen is there will be a change in your accounting policy. The reason being, all the banks are having a policy wherein for performing asset, accrual principle is followed, and for NPA accounts, the income is recognized on the realization basis. Now we have this different class of asset wherein the bank says that these accounts are performing, but income is recognized on the realization basis. So firstly, there will be a change in accounting policy. Secondly, as far as taxation is concerned, income tax authorities will not, accept the contention of the bank wherein bank says that these are performing, but we are not recognizing as interest income. So it will open a kind of a Pandora's box as far as accounting policy is concerned, as well as taxable income is concerned. Now, let me, come to the point about my views about this interim order of Supreme Court. So as far as the Supreme Court order is concerned, it's talking about declaration of account as NPA. So the word declaration is little odd in the sense it's not there in any of the circular. And if you see the writ petition which was filed by one Mr. Gajendra Sharma, his writ petition was asking some kind of a different relief. He has asked for the relief about compounding of interest, his credit score getting affected because of inability to pay even subsequent to 31st August. And there is another hearing which has taken place in the month of November 2020, wherein the applicant has admitted that he has got the relief which we had sought in terms of ex gratia payments which were made. And this particular writ petition has been dismissed. But on the other side, this 3rd September 2020 interim order has continued to prevail. Now there is another ticklish issue about this interim order, and maybe before 31st March we might get an answer. See, any interim order is valid only for 6 months period. As far as my knowledge is concerned, correct me if I'm wrong, but interim orders are never perpetual. So unless and until there is a continuity of this relief which is granted, legally and technically it's not that easy to continue with this dispensation. Another point is that take a case wherein say there is a installment, there are installments in arrears for say 7 months. That is from September till March, someone has not paid any installment. Can you really call that particular account as a performing account and say that I will not make any provision, I will not do any income reversal? That is a little difficult, situation. And all these IRAC norms or NPA norms, they are basically based on RBI notifications or RBI circulars. Technically, if you ask me, and more on the academic side, RBI has been empowered by section 35, 35A and 36 under BRAC to issue guidelines to the banks to be followed. And most of the RBI guidelines are not challengeable in court of law. You can refer to BRAC from academic point of view. So what I'm talking right now is more on academic side. So as far as this interim order is concerned, it's little dicey in nature, in the sense, since RBI hasn't issued any notification to that effect, it's little difficult to digest that in entire banking industry there will not be any NPA which will happen in 7 months. Possibly the way out for that is maybe banks might continue to consider these accounts as PA as far as their NPA marking is concerned. But at the same time, they will disclose that which are the accounts which have got benefited out of that, but they will follow NPA norms as far as provisioning and income recognition is concerned. Now, what is the benefit of this middle way out is, firstly, your P&L will get impacted as if it is an NPA account. So your profits are never overstated because income is also de-recognized to such accounts which otherwise would have turned into NPA. Provision is also made, so that is also getting hit into your P&L account. So P&L is not really affected. Now, as far as if you look at from auditor's point of view, what we are talking about is whether the financials are giving true and fair view or not. So we'll just confine our discussion to that. So if your P&L is getting hit, your profits are at par whether your account is PA or NPA. As far as balance sheet is concerned, in terms of balance sheet, there is no PA NPA status. It is always gross advances which are reported. So even there, it is not going to get affected. Where it will get affected is only to the extent of gross and net NPA disclosures. So there, almost all the banks have opted to disclose the figures wherein the account is not marked as NPA. So there is adequate disclosure which is given by the bank. So presuming that if the disclosure is given by the bank, presuming that the effect of income derecognition as well as provisioning is given by the bank, auditor can do an audit report. The audit report can be framed with kind of emphasis of matter wherein you can draw attention to that particular note and your audit report can get over. So that is the possible way out of that. Otherwise, this discussion will be endless. Even though I am of the extreme view that NPA should be continue to be as it is. Anyway, leaving that aside, the banking practice I told you, the way out also I told you, but just apply your academic knowledge. Just refer to IRAC, especially 35, 35A and 36 sections, which will provide more insight about what is there in Supreme Court order. Just last point I will mention over here about the Supreme Court order. There are a few banks which have continued to mark account as NPA. There are banks which have continued to report these accounts as NPA even in OSS return, and RBI has never objected on that also. I'm just telling all this thing to you informally, not really referring to any bank's name. So just think over it about the Supreme Court order, and we presume that some notification, some guidelines, some clarification should come beforehand in before March end from RBI side. Institute guidance note is getting published at any point of time. The guidance is there in that guidance note also about how to deal with that. As far as branch auditors is concerned, I will expect you to ensure that proper disclosure is given to these accounts wherein this dispensation is used based on interim order. Okay. Now, few things we'll just discuss upon which are old one, but I will just have a cursory glance about certain additional factors related to IRAC norms about project under implementation, because I'm not sure whether it is getting covered under any other lecture or not. So I will try to cover up in say next 10 minutes or so, and then we can have question answers related to this COVID-19 as well as any IRAC norms. So as far as project loans are concerned, the norms have remained same, except one thing, that earlier in case of project loan, the extension of DCCO was permitted for all project loans except CRE section. So now for CRE also DCCO extension is permitted for 1 year. So that is one relaxation which is given. So let's look at quickly as to what is the benefit available under project under implementation. Now, firstly, what is meant by project loan? Project loan is any term loan which has been extended for the purpose of setting up of an economic venture. So that is the definition of term loan under project loan. Essentially, project loan will cover only term loans. CCOD facilities are not covered because CCOD facilities will be subsequent to the commencement of commercial operation, not prior to that. So those will not be covered. Now there is a relevance of date of completion and date of commencement of commercial operation. Whenever a project loan is sanctioned, DCCO is required to be defined under that. Once you define the DCCO, and if a particular project loan, that is the borrower is not able to start the commercial operation by DCCO, the account will turn into an NP account. You need not have to wait for 90 days period for delinquency. Before that itself, it will commit to NPA category after completion of 90 days from DCCO. There are two types of project loan, infrastructure and non-infrastructure. And there is one more thing wherein there is a kind of relaxation given wherever a particular project loan is restructured in terms of giving additional finances or making the repayment period extended. What it has stated is, in case if there is a more than 25% of increase is there in the original outlay in terms of cost or in terms of capacity, then in that case, bank can reassess the viability, bank can do a re-rating, bank can give additional finance, and bank can reset the DCCO. So just to give an example, suppose you are having a loan which is given for say 100-bed hospital, and now the hospital is thinking to expand that project and going for 150 beds hospital. So its original project is expanded beyond 25%. So in that case, you can reschedule the entire structure, you can give additional finances, and that will not be considered as restructuring. In the sense, you can retain the class of asset in that particular case. Then deferment of DCCO is permitted. So wherever in case of infrastructure loan, you can extend it by 2 years. In case of court case, you have a period of 4 years. And in case if there is any other reason other than court case, like say funds are not made available by government, or maybe land acquisition is pending, then in that case, additional 1 year is there. So without any reason, 2 years extension of DCCO is possible. With reason of court case, 4 years extension. With any other reason, 3 years extension. And similarly for non-infrastructure, 1 year is possible. And in case of court case or any other reason, 2 years extension is possible. And as I stated, for CRE section, 1 year is now being permitted for restriction. These norms have remained same about the CRE section, as I already stated. 1 year is now has been given as a benefit as per circular dated 7th February 2020. That can be availed as a benefit. Additional provisioning is requirement is there wherever DCCO gets extended beyond 2 years period. Then we have one more extension possible wherever there is a change of ownership is there. So whenever the promoters have changed because there is an inadequacy on the part of the present promoters. So the new promoters are replacing the existing promoters. You get an additional 2 years period. So practically, for I'm saying a hypothetical case, if you're having an infrastructure project loan, wherein court case is there, and plus there is a change of promoter is there, practically you can extend DCCO to the extent of 6 years. And this benefit is available only once. So it's not like every time 2 years extension is practically possible. Then as far as financing of cost overruns is concerned, which can be in the form of standby credit facility also. So you can either sanction it at the time of financial closure or in between also for finance, cost overruns you can sanction. Now in that case, the additional financing is restricted to the extent of 10% of original cost, and even if additional finances are given, it will not be construed as restructuring, and still you can retain the class of assets. So you don't have to really downgrade a particular project loan because of financing of cost overrun, provided they are limited to the extent of 10% of original cost. Then as far as income recognition is concerned, norms have remained same. So I will just reiterate the norms. For NPA accounts, it will be on the realization basis. For non-performing accounts, it will be on as far as the unrealized portion is concerned, you have to make provision or you have to reverse that. So as on the date of NPA, you have to see that what is the interest portion which has debited in the account, which is not serviced. And service in the sense, if you don't have subsequent credits, it will be called as unserviced interest. So to that extent, either you have to reverse the interest or you have to make a provision for that. Interest income, which is given as a additional finance in NPA accounts, will be recognized on cash basis. In case of project loans, funding of interest, if it is done, then that will be required to be fully provided for. If the interest is converted into a unlisted equity, then it will be recognized fully to the extent of market value, provided it is a listed entity. As far as order of recovery is concerned, there is a discretion which is given to the bank that the bank can decide about the order of recovery. So whether to first recover unrealized expense or unrealized interest or principal outstanding, that is bank specific. Only thing is that bank should have a policy about order of recovery, and that has to be followed in uniform and consistent manner. So it cannot be account specific, it has to be bank specific. So bank as a whole has to decide that. Classification norms have remained same. So standard asset will be all accounts which are not non-performing. Again, we have now a special class of standard asset according to the bank, which are not marked as NPA based on the Supreme Court order. Then we have substandard assets, which are assets which are marked as NPA. So for first 12 months period, it will remain under substandard asset category. Then it will go to DA1, then DA2, and then DA3. Loss assets are those accounts which are identified by either by the bank or by internal or external auditors or by RBI inspectors as fully non-recoverable. But the amounts are yet to be written off, so those will be called as loss assets. DA1 will be the account which will remain in DA1 category after the period of substandard asset. So for 1 year, it will remain under doubtful 1. Then next 2 years, it will be under doubtful 2 category, and then it will go under DA3 category. Provisioning norms have remained same. So these are the standard asset provisioning norms. No change has occurred in these norms. Then as far as substandard asset provisioning is concerned, you have to make 15% provision wherever the loan is secured. In case of unsecured, you have to make 25% provision. In case of infrastructure loans which have been backed by escrow facility, you have to make 20% provision. Definition of secured asset we already talked about. That is, if the security is not less than 10% of exposure ab initio, that is at the time of sanction, then it will be called as a secured loan. Doubtful asset provision, no change in that. For unsecured portion, you have to make 100% provision. Secured portion, you have to make 25% provision for DA1, 40% provision for DA2, and for DA3, you have to make 100% provision. Intangible security will be considered only if it is backed by legally enforceable and recoverable rights over the collection, and rest intangible like patents, rights, licenses will be considered as unsecured. It will not be counted for that. So brand name, trademarks are not really considered as eligible intangible security. So the value will not be considered for calculation of secured and unsecured portion. These are country-specific norms, not really applicable for at the branch level. So I will just skip that. It is just for reference purpose. Provision under special circumstances, as far as advances which are under rehabilitation program, wherever the terms are renegotiated, after 1 year, the account will be eligible for upgradation. Advances which are guaranteed by CGT, SI, CGC, the provision will be required to be made only on the balance amount, which is in excess of the amount which is guaranteed by these guarantee corporations. As far as takeout finances are concerned, as you are aware, these are the typical arrangements wherein a loan might be of a longer tenure. And in these cases, the bank has to compulsorily acquire the loan for the fixed tenure from the other bank. So suppose the loan is say for 15 years. It might be the case that first 5 years will be by bank A, then it will get taken over by bank B, then for last 5 years it will be by bank C. In that particular case, what will happen is, whatever is the asset classification is there with bank A, suppose it is an NPA account, then bank B, while taking over that particular account, has to continue with the same NPA date. So it will not be a fresh NPA date which will be there. And in certain cases wherein the takeout finance is done, wherever the repayment cycle is extended, it will not be considered as restructuring provided certain norms are fulfilled. So firstly, if it is a project loan, it has to be a standard account. It shouldn't have been restructured in the past, and the substantial portion should have been taken over under this takeout finance. That is, more than 50% should have been taken over by the next bank. And repayment period should not be exceeding the life cycle of the project. So if that is the case, then even if the repayment cycle is extended, the account will not be considered as a restructure. Post-shipment suppliers credit. As you are aware, Exim Bank has introduced guaranteed refinance scheme. So in that case, the guarantee claims are getting settled within 30 days. So these accounts will not be marked as NPA unless the claim is not getting settled. In case of export project finances, it might happen that a particular borrower has exported certain commodities or goods to other country, and the recipient, that is imported in that country, is not able to remit that particular amount to India because of maybe some regulatory restrictions which have been imposed in that particular country. So in that particular case, the borrower in India might open an account in that country. He should produce before you the documentary evidence that the amount is received in that country. Only thing is that it is not remitted back to your country, that is to India. So in that case, there is an additional period of 1 year which is granted to bring back that amount in India. So NPA classification norm will indirectly get extended by 1 year. As far as guidelines of restructuring of advances are concerned, they have remained same. Practically all types of accounts can be restructured. There is no bar on that. Eligibility is like whether it is a standard, substandard, or doubtful asset category loan, everything can be restructured. Only thing is that restructuring cannot be done retrospectively. Secondly, restructuring will be always subject to customer agreeing to the terms and conditions. So it's not so moto restructuring which a bank can do. Financial viability has to be established. Borrowers which are indulged in fraud cases or falsification of accounts are ineligible. BIFR, of course, now it is not there, but old BIFR cases are subject to approval from BIFR. And stages at which restructuring can be done, practically at any stage you can do a restructuring. So whether it is PA, NPA, it really doesn't matter. Asset classification norms are that your account will get downgraded immediately after restructuring, and it will be eligible for upgradation after satisfactory performance for 1 year. So bank can opt for restructuring of any account. I'm not talking about COVID-19 because all those are kind of a dispensation which are given from calling it as a restructuring. So rest any account in a normal case can also be restructured. And now satisfactory performance is also defined. So for non-agricultural CC account, the next 1 year within next 1 year, if the account is not overdue for more than 90 days, that it is not out of order, and it is not overdue at the end of that 1 year period, the account is eligible for upgradation because it has shown a satisfactory performance. For non-agriculture term loan, same logic, that during that intervening period of 1 year, in that period, none of the installment was overdue for more than 90 days. And at the end of the period, no overdue position is there, then the account will be eligible for upgradation. For agricultural loan, if there are no overdues at the end of specified period, that is sufficient satisfactory performance, and the account will be eligible for upgradation. As you are aware that whenever a standard asset is marked for restructuring, then it will be considered as NPA. So there are twofold provisions which are there. One is normal IRAC provisions. In addition to that, if there is a DCCO which is extended beyond 2 years or restructuring getting beyond 2 years, the additional provision of 5% is required. Another thing is that there will be a sacrifice provision which will be made. So the option is that you can calculate the sacrifice, that is compare the old cash flow with the new cash flow, calculate the DCF value of both the cash flows. If it is an adverse position, you have to make a provision for that, which is a sacrifice provision, and on year basis, you have to recalculate that. If a loan exposure is below 1 crore, then you have to make just a 5% notional provision, and you don't have to do the complex sacrifice calculation in that case. Calculation of sacrifice, this is a methodology about what is the discount rate which you have to apply. Just to put it in simple words, the interest rate applicable to that particular borrower account should be used as a discounting rate, and you have to calculate the sacrifice. Working capital finance, the sacrifice calculation will be presuming that tenure is for 1 year. Special regulatory treatment, even though I don't have to really reiterate, but just for the sake of clarity, I'm reiterating. Quick implementation package is withdrawn in April 2015 itself. So that really doesn't work. So any loan which gets restructured will be getting downgraded. These are the circulars which have got abolished. That is 30th January 2014 circular. Framework for revitalization of distressed asset. Flexible restructuring of long-term and core industry loan, SDR, S4A. 12 February 2018 circular also has got abolished, and it has got replaced by June 19 circular. So subsequent slides are more on that. I think I will just take a couple of slides and we'll take up question answers. This is the part of 30th January 2014 circular, which talks about setting up of CRIL. So just I wanted to stress upon that CRIL reporting is mandatory for all the exposures which are above 5 crores. Criteria are SMA0, SMA1, SMA2. SMA0 are those accounts wherein the amount is not overdue for more than 30 days, but showing some incipient signs of stress. SMA1 are 30 to 60 days overdue. SMA2 are between 60 to 90 days. Incipient signs are also defined in the circular, that if any of these signs are visible, then you have to presume that it is a SMA0 account. Joint lender forums and other criteria are dispensed off. So I will just take you to the subsequent slides. These slides are just written for the purpose of reference purpose. Now what is really applicable is 7 June 2019 circular. It's not a new circular per se. So we will not go deeper into that. Instead of that, I will take up the queries. I'll just take a few last slides before I turn to the queries. I have even included the norms which are related to sale of financial assets to reconstruction companies. In case if any one of you happen to be there in asset recovery branch, this portion will be relevant to you. For normal branches, sale of financial assets and securitization companies, that ARCs sale and all these things are not really applicable. So I'll just touch upon a few points to reiterate. Para 4.2.2, which talks about internal system establishment about auto marking of NPA, to be specific, that NPA identification and marking process has to be on continuous basis. Para 4.2.5 talks about arrears of interest and principal should be repaid back for upgradation of the account. Annexure 5 talks about what is the definition of restructuring of an account. So it says that for economic or legal reasons relating to borrower's financial difficulties, if there is a concession which is granted to the borrower account, it would be considered as restructuring. Let me just give a few examples on that. See, in case of account, firstly, there has to be a concession granted to the borrower in terms of either interest or principal, and that should be because of borrower's financial difficulty. So if a bank grants an interest concession because of market competition to retain a particular borrower account, that will not be called as restructuring. Secondly, there has to be a concession granted. So suppose there is a OD facility and that OD is now converted into a drop line OD, or OD is getting converted into a term loan account. That will not be called as a restructuring, because in fact the borrower will start repaying the loan. So it's not a concessional facility which is given to the borrower. So that will not be considered as restructuring. Third thing is that as far as replacement of collateral or primary security is concerned, presuming that on the date of replacement, account otherwise was a standard account, in the sense DP was adequately available, merely replacement of security will not be called as a restructured account. So restructuring is a concept which is related to granting the concession because of borrower's financial difficulties and not otherwise. These are few points which you need to keep in mind about, especially about divergence cases, which RBI has been harping upon. This is the second consecutive year when RBI has written communication to CA Institute about the divergences which have been observed in case of NPAs. And friends, actually a little bothersome point is there about what RBI is writing to CA Institute. All the cases of divergences which RBI is saying that they are observing across the banking sector, all those cases have been already been getting discussed in various seminars like what we are having right now. The cases are very much there in the bank audit guidance law also. So just make it a point that you are not having any account which RBI is subsequently identifying as a divergences. So be careful about NPA classification norms. There is no relaxation which one can give. About Supreme Court judgment, ensure that disclosure is proper. And also you can review the communication from central auditor to you, and you can always make it a point to disclose it adequately in your LFR as well as your report by saying that which are the accounts which are not marked as NPA, what is the policy which the bank has adopted as far as income recognition and provisioning is concerned. Also pay attention to date of NPA, whether date of NPAs are getting modified or not, and just compare the opening NPAs with the current year NPAs, and also pay attention to accounts upgraded during the year. MOCs, I did not have to say, I think in LFR that must have been covered. Calculation of drawing power also is a kind of bothersome point about the methodology of calculation of DP. Just pay attention to that. Early mortality cases, I think I did not have to say anything more about that. All of you are well aware of that. So that was all. I think we have some time still left. I have purposely kept that time so that I can take up the question answer. So let me just read the questions and try to answer all. What is the order of recovery recognition in case of NCLT, regular NPS, OTS in standard accounts like agriculture? See, Ankitji, actually every bank order of recovery defined in their accounting policy. Just I will give a few examples. To start with NCLT, the question which you asked. See, suppose in NCLT order, if there is a specific order which mentions that what should be the order of recovery, the bank will go with that. Otherwise, bank's normal practice will prevail. As far as OTS schemes are concerned, many banks are having a conservative policy that in case of OTS, they say that firstly principal will get adjusted and subsequently expenses and then interest will get adjusted. But the bank should have the policy and it has to be consistently followed. For regular NP also, bank needs to have a policy which has to be consistently followed by the bank. In case of delayed resolution plan account, shall we consider non-fund based portion for calculation of provision as exposure word written in the entire circular, but the provision part is outstanding word is written. Yeah. If there is a delay in the resolution plan, let's presume that there is an invocation which has happened and the resolution plan is yet to be implemented. So during that intervening period, anyway, normal NPA norms are applicable. After resolution plan gets implemented, then the provision has to be done on the outstanding word. So there naturally non-fund based portion will not be there. So non-fund based portion is only for exposure exposure part. So wherever exposure word is there, fund plus non-fund is there. Wherever provision is there, it's based on outstanding amount. Mahesh has asked a query. Interest on cash credit for period 1st March 2020 to 31st August 2020 is not paid by 31st March 2021. It is not converted into FITL by the bank. What is the treatment to be given? Okay. See, firstly, if it is FITL is not opted by the bank, it means that the entire portion is due on 31st August 2020. So the reference of 31st March 2021 is related to only in those cases where FITL is there. So what RBI is expecting is that wherever FITL is opted for, that FITL should be paid before 31st March 2021. So if FITL is not opted, the entire portion is due on 31st August 2020. In case of credit card IRAC criteria, please explain the example. Okay. As far as credit card are concerned, let's presume that total credit card dues are say 10,000 rupees in a particular month. So the due date is say 7th of let's presume that October month's credit card is there. 7th June is my due date. Now on 7th June, if you're typically seen, there is a portion written as minimum amount due. Typically 7% to 10% amount is stated. So suppose 10,000 rupees is your credit card amount, credit card statement amount. 1,000 is due on say 7th of November. If this 1,000 rupees is not paid within 90 days from 7th of November, then the account will be called as NPA. So not entire 10,000 rupees are required to be paid. It is a minimum due portion which is required to be paid. So that's how IRAC norms will get applied for credit card dues. Any further queries about any COVID-19 circular or any IRAC norm circular?
Sir, actually, I don't think there are any pending queries now.
Okay, so I will just like to thank all of you once again, even though virtually. Let's see, when we can meet physically, maybe in coming months to come. So thanks to all of you for making this session interactive, because otherwise it becomes a kind of monologue for me also. So thanks for all those who have posted the queries, and I'll be sharing this presentation with the branch so that you can circulate that. It has my email ID as well as mobile number. So in case of any one of you having any queries subsequent to this presentation also, you can very well ask for those. I'll just take up one query which has been posted by Ankit ji. Shall we classify accounts as NPA and report to SCA as hold account for requirement of provision at HO? Actually, there is nothing like hold account. It will, frankly speaking, it will depend upon how the bank wherein you are doing the audit is taking up the circular in terms of adoption. Ideally, all central auditors will be conveying to the branch auditor about making a separate kind of reporting requirement for such accounts which are otherwise would have been marked as NPA. The real challenge will be that how the banks are dealing with such accounts in the system. I will just take 2 minutes for that. Let's presume that a bank has stopped identifying account as NPA, and your central auditor wants to identify the accounts which otherwise would have been NPA. Now the challenge before you will be, as on 31st March, if you take a overdue statement or a defaulter statement, it might show you 2 installments overdue. And you will presume that this account is anyway otherwise standard account, but that may not be the case. Because maybe in the month of say January, the account was having 4 installments overdue and there is a partial recovery. Now, if the bank has completely stopped the identifying process, then such accounts will never get revealed. So you need to be very careful about such accounts, and you need to be practically doing some exercise manually. Unless bank has a CBS enabled parameterization, which according to me none of the bank is having. So that's where the real challenge will be for the auditor. And another point, just for your comfort level, I will say, in case if you are not able to do that manual exercise, disclaim in your report what you haven't done. Don't say that everything has been done by you. So whatever is done by you, you be vocal about that. Whatever is not done by you, that also be vocal about that. If something is not made available to you by the bank, be vocal about that in your LFAR and report, depending upon gravity of what has been not made available to you. So don't shy away from writing anything in the report. It doesn't mean that you should write essays in the report. Be concise and precise. Don't just qualify any report just for the sake of that. One more point which I will like to mention based on my last year experience. See, there are multiple WhatsApp group which gets floated for different banks, and there are standard comments which also get floated. Last year I had a couple of requests by asking me that how to qualify a report. See, there is nothing like how to qualify a report. It will be branch specific or auditor specific. You cannot have a standard comment. So don't copy paste any comment. Read standards on auditing carefully. Essays are mandatory. So essay 700, 705, 706, these are the key essays which you need to be aware about. You need to know the difference between modified report and qualified report, and disclaimer of opinion, and what is meant by emphasis of matter or other matters. So be clear about that. Just because something is not being checked by you, don't qualify the report. Okay, one more query is there by Bhavikji. Small loan accounts having primary security like sewing machine, etc., having guarantee from government. If no recovery in such accounts, how to classify? See, actually, these are guarantee schemes and not really guarantees by government per se. So these are not central government guaranteed accounts. So in that cases, normal NPA norms are applicable, unless they are covered by CGTMSE schemes, wherein the entire amount will be paid once the claim is invoked. So you need to verify that whether the claim is invocable or not. If the claim is not invocable, it's only a guarantee to the limited extent of some incentive which is getting passed on. Normal norms are applicable. No dispensation of norms will be there. Okay, I think you're through with the query. Thank you once again.
Yes, sir. Thank you so much, sir, for your amazing and elaborative deliberations, sir, today. I would now request the chief coordinator for the session, C. Ankit Thakkar, to give a vote of thanks. Ankit, please unmute.
Thank you so much, sir, on behalf of ICAI Ahmedabad branch for providing detailed review on IRAC special focus on COVID-related special dispensation and status quo ordered by Supreme Court. We are really enriched by the knowledge of your sir. This session is really going to help one and all in carrying on bank audit. Thank you, sir, for taking time from a busy schedule on a working day and guide us. Thank you, everyone, for joining.
Thank you, sir, and we look forward to having you soon at physically also at Ahmedabad.
Yeah, yes, sir. It will be my pleasure actually. But I think even last year we decided, but we somehow couldn't make it up. So let's see, when we can do it at this possible time.
No. Sure, sir. Thank you so much, sir, again. And we look forward to having you soon. Thank you, sir.
Thank you.